Treasury Select Committee and our inquiry session this afternoon looking at the cost of living. We're very pleased to be joined by three witnesses this afternoon. I'm just going to ask them to very briefly introduce themselves to the committee, and I'll start from the right, or my right, so I'll go for Robert first, please.
I'm Robert Joyce, Deputy Director at the Institute for Fiscal Studies.
Thank you, Robert, and welcome. Torsten.
I'm Torsten Bell, I'm the Chief Executive of the Resolution Foundation.
Thank you very much, Torsten. And Tom.
Tom Clockersy, Head of Tax at the Centre for Policy Studies.
Lovely. Right, I'll start with the first question for all three of you, but perhaps I can invite Torsten to come in first and then our other two witnesses. Inflation, we know, has taken off rather more dramatically than many assumed some time ago. And I wonder if you could just reflect for the committee on what you see driving those inflationary pressures. Comment on the debate between whether it's going to be a sort of transient or now going to become rather more persistent. And critically, and this is the answer I'd like from all three panellists, if I may, what sort of impact is it going to have across the income and household spectrum, particularly on those that are less well off? How is that nature of that inflation going to play out in that sense? Torsten.
That's a large question. So, as you say, it has risen faster than any of us, and broadly conceived us, expected. The OBR was expecting only 4.5% to be the peak just as recently as October, and obviously we're now heading to high sixes, more likely 6.5% as the peak in inflation. In terms of what's causing it, that's well discussed. If you look at the annual rate of inflation, the two biggest contributors are transport and housing/utilities, broadly adding about 1.2% to that 5.5% that we're currently seeing. So that's the big picture of what's going on. Obviously, what's sitting behind that is two big things. What's happening to global hydrocarbons, in particular gas prices, and what that does to the cost of energy and to the inputs in lots of other people's production. And then secondly, a global reopening of an economy where we're particularly focused on demand for goods and that running up against supply constraints. And the two things together, I particularly emphasise the gas prices is giving us high inflation rates. In terms of what that's doing across the income distribution...
Before we get to that, the point about how persistent this is going to be, are these factors that you think are looking more long-term now than they did a little while ago? And what are your thoughts?
So the answer to that is yes. So certainly, the bit that's got certainty is to say, are these looking longer-lasting than we expected a while ago? Yes. How persistent, I think all of us should have lots of humility, and it's very uncertain about how long-lasting it should be. I think the things we should think about within that are, so if we think about the energy price pressures in particular coming through as like a primary cause of that inflation, so how long those last themselves, where in other contexts you'll be discussing the geopolitics lying behind some of that, is obviously highly uncertain. My general view is that energy markets people generally overstate the persistence of whatever's going on right now then. So right now everyone's saying high rates, therefore going to be high forever, therefore reopen all of the North Sea oil fields. And a few years ago they were saying low oil prices, this is going to be like this forever, and so we should give up on the whole thing. So I think we should be humble about how long that we think that's going to last. Then more interestingly, the second round effects of that, if you look at what's happening to producer prices on the goods side, those are obviously, they've come off a bit in the most recent data, but they're highly elevated, and that's what's going to drive the second round of price rises over the course of 2022. So that's companies, particularly on the goods side and to a lesser degree on the services side, putting up prices to deal with their input prices going up. And those input prices aren't just energy, they include lots of other things, but that generally is going on, as I say, on the services side, some of that, but less so. That's even more true in the US. So you've got that, and that will give us the next round of price rises. And that bit, I think, is very likely to happen. So we should, with decent level of confidence, think that we've got another round of price rises not directly related to energy that come through as a second round effect into the middle and second half of next year. We've then got uncertainty about what feed-through loop we get from wages. And again, I would think about that in two ways. I wouldn't think about it in the way it's sometimes discussed, which is people say, we're going to get a wage price spiral. What they mean is a price wage spiral. So they mean people respond to to high price rises by asking for big wages, and that drives another round of high price rises. I wouldn't think about it in those terms, but what I would think about it in terms of is just a straightforward, are we going to have a tighter labour market driving demand, driving wages up, and will that, if that's faster than productivity, will that feed through into unsustainable price rises? I personally would attach low probability to that at the moment, but I think it's reasonable for people to be focusing on asking that question, and the answer will be different in different countries. Would you like me to cover the distribution?
Please.
Right, so the distribution broadly, in simple terms, and try to do it quickly, is so far the effect across the income distribution of price rises in aggregate reflecting different consumption baskets is broadly flat. It's not that interesting in terms of what is going on. That's in terms of inflation rates. In terms of its impact on actual people, though, I don't think we should discount a very big differential effect on lower income households for three reasons. One, because a given inflation rate is much harder to deal with if you're on a tight budget. 60% of the poorest fifth of families have less than 1 month's income in savings. That's 70% for single parents, for example. So the ability to cope with it is just very different if you're on a lower income. Secondly, when the energy price rise, that's because we're very unusually, for us, and actually globally, having this energy price rise all at once at the beginning of April. When that comes through, that will move to a higher inflation rate for lower income households. Not massively higher, but higher because their consumption basket is biased towards essentials, and that includes energy as well as food in the way it did back in the financial crisis when food prices did peak in a much greater way than they are right now. And then the third reason we might want to think about it is for the very poorest, who won't show up in our decile by decile way of looking at the income distribution, who are reliant, who are particularly just trying to get by on the very cheapest foods. There are other questions about the availability of those goods, which aren't really to do with, they're much longer term trends, they're not really to do with the short term pressures on other prices.
Great, and I think we'll come back to that specific point a bit later. Thank you. Who would like to come in next on the discussion? Robert, do you want to
go ahead? I think I've got very little to add on my understanding of the outlook and what's known and not known about that in terms of the persistence of inflation. Is Torsten's? I don't have anything to add. I don't think over what Torsten said, and I also, in terms of the prospects of a price-wage spiral, as Torsten put it, I also at the moment don't see much sign of that. Real wages clearly are falling, I think, already, and look like they will be doing so for some time. The big
just
danger
ask on that, Robert.
Yeah.
Were you? I think when we had the governor of the Bank of England before us very recently, he did suggest that there was some evidence of this hot labour market spilling out of the classic pockets that we've all been talking about in terms of surveys through Bank of England agents and so on. Did you read anything into that, or?
Yeah, I think so. I think there is some, and also some early evidence as well of longer term expectations about inflation becoming a bit less anchored, which is one of the things that you would look for as a kind of leading indicator that there may be a bit of dynamics going from prices through to wage setting. So I don't say there's no evidence of it or no sign of it as yet. It's minor at best, as in terms of across the whole economy anyway.
And when you mentioned de-anchoring of the inflationary expectations, what do you see as the main drivers of that? What is it that makes the public think at the moment where they're negotiating the next round of wages, whatever, actually inflation's really moving up here? What are the kind of elements there that drive that behaviour?
I mean, I think things that are more salient to people, I guess, could matter somewhat more, like energy being a good example. I think as well, might sound a little banal to say it, but the longer that inflation does remain elevated and the less it looks like some of the pressures we've seen are going to go away quickly. Obviously that, just the longer it goes unabated, the more there is a risk of that. On the distributional point, again, not much to add, I guess, over what Torsten said. I mean, so far, if you compare different income groups, the differences, as far as we can tell, in the rates of inflation they face have been pretty minor. One of the reasons for that is because although the price of domestic fuel has been rising, the price of transport has also been rising. Road fuel has been getting more expensive, and that tends to be a bigger budget share higher up. So to some extent, those two things have balanced out a little bit. But, as Torsten said, in April, the spike in domestic fuel prices will have a significantly bigger effect towards the bottom because they spend larger shares of their budget on average than higher income households. So that's where we're going to see a bit of a differential opening up Not massive, something like maybe a difference if you compare the top and bottom income deciles of around 1.5 percentage points in terms of the annual rate of inflation at that point. So that is significant, but just to put it in context. So that's where we'll see a distributional difference really opening up, and heating will be key to that.
Okay, thank you. A lot has been said, and no need to repeat anything, but do you have something to add?
No, I mean, a lot has been said, and I agree with, more or less what has gone before. Supply bottlenecks, energy prices. My colleagues who look at energy particularly, they think it's likely to remain, energy prices will remain high the next couple of winters. So that's not something that's going to go away. Will it get worse? Probably not. The supply bottlenecks, I think you would expect to improve unless there are big setbacks on the COVID front. So, I mean, my view is basically with the consensus that this isn't going to be persistent inflation, but obviously there are risks. COVID, rearing its head again would be one of those risks. Loose monetary fiscal policy driving price rises is an outside risk. I mean, I really don't see any sign of that in the UK. We may have the other problem, but that does seem to have been part of the equation in the United States, why they've had rather more elevated inflation than Britain and the Eurozone, for example. Inflation almost always hits the poorest hardest because they spend more of their money on essentials. I don't expect it to be any different in this case. Obviously people on tight incomes are going to struggle with huge energy price increases, especially older folks who have no option but to keep the heating running if they're going to have a decent winter. So, I think this problem is here for a while, but I don't think that we're in any immediate danger of things spiralling out of control, at least not as I see it.
Yeah, okay. Well, thank you very much. Now I'm going to go to Siobhan, who's going to ask a bit more, I think, about these hardest hit.
Yeah, there's a slight overlap in what I'm going to ask to what the Chair's asked. And I'd ask you for your views on who's feeling the effect of the cost of living increases, just as you've already referred to. And I'd like to begin with the same question to all of you before following with a more specific one. And just we know the cost of living differs between lower and higher incomes. We know poorer families are more likely to be on a key meter for their gas and electricity, to have their connectivity on pay-as-you-go, and generally be less likely to be the informed consumer that's always looking for the best deal on contract, because you don't want a contract if your monthly income goes up and down. When everything is added up, inflation, national insurance rise, the energy costs, the broadband costs, the council tax rises, who will be hardest hit and why?
Start, go on the line. So in terms of bringing all those things together and thinking about who's hardest hit, I would distinguish between a couple of things. One would be the overnight things that we're going to see happening in April, because there's some of the important effects we'll see quite sharply at that point, like rises in energy and also the increase in national insurance would be two of the key examples. So in terms of the overnight changes that we're going to be seeing there, everyone will be suffering a little bit because you've got those things are both bad, obviously, for households. They will tend to roughly balance out in terms of the kind of average proportional effect across the income spectrum, because basically the rises in energy prices hit the bottom more proportionally, but the increases in national insurance hit the top more proportionally. So in April specifically, there's in that sense a bit of evenness, although even within that there's more nuance, of course. So those on the minimum wage will tend to do relatively well because they'll get a more than 6% increase in the minimum wage at that point. Although note that those people are actually mostly concentrated more around the lower middle of the household income distribution, not right at the bottom. So in April specifically, there'll be pain for everyone. As ever, as has been said, those on even for the same sort of proportional hit to income, those on lower incomes are going to find that harder to adjust to because they're already on a low income. Zooming out a bit and taking something more like the year as a whole, comparing next year with last year, which I think is also important because there's a lot of other things going on as well. Well, there I think it's clearer that the bottom overall will be having a worse year comparing kind of next year to last year, and that's because Mostly because if you compare where they are now with where they were a year ago, they've lost about £1,000 a year in universal credit if they're on universal credit. So really, in combination with a slightly higher rate of inflation over the year as a whole faced by the poor, and the loss of that, albeit always temporary, increase in universal credit, over the year as a whole, they've seen more of it. They would have seen more of a deterioration. Less so for some of them, again. So for those who are both in work and on universal credit, they benefited from increases in universal credit in December. But in terms of the general picture, that's how I would summarise it. Kind of overnight in April, more distributionally neutral, but still therefore more difficult for those on the lowest incomes. Year as a whole, toughest at the bottom. That's the way I would summarise it.
Awesome.
Yep, so I absolutely agree with that. I think it's going to be a pretty tough year for the whole country is going to feel squeezed through 2022, and lower income households are going to struggle most to deal with that. As Rob said, I think the key issue is less on the cost side and more on the income side, where you see really hard questions for the lowest income households because of the £20 a week removal from universal credit. I think then within the deciles, you do need to look pretty hard. There's a lot of variation, and I highlight two big sources of variation to think about. On energy bills, there are very large variations amongst households. Within that, the drivers are poorly insulated houses, which as a country we've been absolutely useless at making progress on. In fact, we've slowed down our progress over the last 8 or 9 years. That's a disaster that we're all going to be regretting this winter as our bills come in. And that makes a big difference. Age of boilers. Old boilers are a disaster for your energy bills. Lastly, having lots of kids. Having a big family, I'm not saying there may not be a disaster from other aspects of your life, but for your energy bills, it's definitely a disaster for that. So those three things together lead to large variations amongst households. And again, you do not want to be a poorer household that's got a poorly insulated home, that's got a large family and has got an old boiler because you haven't replaced it. That's going to be a really tough situation for you coming into and as you mentioned earlier, prepayment meters won't help on that front. If you look at the energy cap increase that happened in October already, it was obviously higher for people on those forms of format. So big variation that I think is under-discussed on the energy side. On the national insurance side, again, obviously much higher for the top of the income distribution, giving you this flat overall-ish structure when you think about it along with energy bills. Again, as we've discussed with this committee lots of times before, the reason why the national insurance rise is a bit of a turkey of a way of raising this money is because of the big variation of how different kinds of income are treated within that. So it's only on earnings, not on any other kinds of income. So people that otherwise look very similar, some are getting a tax rise, some are not getting a tax rise in the course of this year. That's not a very good idea.
Thank you. Tom.
Yeah, I mean, again, I agree with what's already been said. I think, though, that I would caution against framing the cost of living problem solely as an issue of the poorest in society and as something that you fix by giving them more money. Now, that's definitely a big part of the problem and that's part of the solution. But I think there is a much broader issue here as well, because we do have, I think, general cost of living issues in this country, removed from the sort of immediate crisis around energy bills, cost of housing, for example, cost of childcare. And I know there are a lot of, relatively quite well-off people who nevertheless have not much flex in their budgets because of these underlying issues.
Everybody lives up to their income, don't they?
Exactly. And so when you get a big energy price rise, or something like it, that can cause problems even for people who are in pretty good shape on paper. The reason I raise that is not to say let's think about well-off people as well, but to say actually let's consider some of the structural reasons behind cost of living issues in this country. Because in the short term, yes, if you have vulnerable people who can't afford their heating, the solution is to give them more money so they can afford it. But longer term, if you're thinking about housing, if you're thinking about childcare, even if you're thinking about energy costs, actually it's about how those markets function and the underlying fundamentals there. And if we want to make people feel just better off in general, and I think probably that's everybody's goal, regardless of political persuasion, well, you need economic growth so their incomes are growing. But you also, I think, need to address some of these long-standing supply-side issues in those various markets, which just make prices higher than they could or should really be.
Thank you. And to you, Robert. ONS data published last week indicates that in December 2021, low and high income households experienced roughly similar rates of inflation. However, IFS analysis showed that those on the lowest incomes are likely to experience significantly greater inflation rates than those on the highest income. To what degree are you anticipating a greater divergence in inflation rates experienced by low and high income households this year? And what are the reasons for this? And do you think it's often because we're not making good judgments or assessments of how different people's how inflation is and different things that people need? I'm thinking particularly about Jack Munro and the work that she's been doing.
Okay, yeah, so first, in terms of the sort of apparent discrepancy between the ONS figures about December and some of the analysis we've put out, that's actually in some sense simpler than the issues that Jack Monroe is raising, which is what we've said there is that in April is when you'll start to see a more of a difference in the inflation rates faced by low and high income households. So we too think that up to around December, up to now, there hasn't been that much difference. And this is, again, partly the point I raised about actually high income households have been hit more by rising road fuel costs, for example. So it's not only domestic fuel that's been going up in price. But in April, you will see a difference. And I would expect the ONS figures at that point to show a difference because that's when the energy will go up a lot. And that is definitely proportionally a bigger deal for those on lower incomes on average. Then you raised really a different issue, but also an important one, I think, about... there's a few related things coming up in the debate that Jack Monroe has kicked off. But I think one of those is about the way we measure the prices of different goods at a very fine level, and the idea that we might be missing something because, for example, whilst the ONS will try to separately measure the price of bread from the price of pasta, it doesn't differentiate between sourdough bread and basic ranges, and of course those prices could be changing quite differently. That's at least one of the issues that's been raised. There is actually more than one debate kicking around here. But I think that is important. There's work from the US over the period 2005 to 2014, which suggested over that period, if you do use very fine-grained data, which is becoming more possible because data is getting better for a few reasons, that it does make a difference, and that, again, in that period in the US, once you do that, inflation looked worse for the poor relative to the rich because within those product categories there were these differences. So I think that is something that could be important, and it is something that we increasingly have the potential to do better with because there is more and more fine-grained data on what people are buying from things like scanners at supermarkets and things like that. Yeah.
Thank you. Torsten, the Resolution Foundation has pointed out that whereas inflation rises impact on lowest income households the most, tax changes hit middle to higher income households more. If tax changes are considered alongside the increase in inflation, which are the hardest hit households in terms of absolute and proportionate income changes?
Well, I think I don't have anything to add to what we said earlier, which is everyone's going to be hit. It's going to feel like a big squeeze for everybody, and the lived experience of that is going to feel like a catastrophe for lower income households if nothing changes as we head into April. In terms of the difference between absolute and proportional measures, in general, if you took the whole package in April together, you probably will see a pounds and pence worse outcome for the very richest because they're paying very large increases in national insurance, but obviously it's as a proportion of income that we should be thinking about it. And as I say, it's flat overall, but that's going to turn into a lived experience of being very, very serious for poor households who, if you're finding it struggling to manage right now, you've just had your income reduced by £1,000 because you're out of work or on very low earnings, so you don't benefit much from the taper rate that's come in, and then on top of that your energy bill goes up by £700. You didn't have £2,000 worth of wriggle room in your household budget last September, and you ain't going to find that easy to deal with now, and that should be our number one priority.
We've often spoken at the committee when you've been a witness about the amount that higher and middle income households were able to save because of lockdown and being able to work from home. So presumably that will cushion them against some of the increases.
Yeah, so overall, as you say, we've talked about very large, hundreds of billions of pounds of excess savings. By excess, we don't mean too much. We just mean more than we had expected to have pre-crisis. And yes, that is overwhelmingly been accumulated by actually quite top-heavy, not just the middle, top-heavy. You need to basically have been going on expensive holidays to have saved very large amounts of money, but commuting costs have also helped some households to save. At the bottom, we've seen the opposite, which is them taking on more debt, particularly in the earlier parts of the crisis. And so that is where our worry should be about balance sheets deteriorating over recent years. Overall, what we haven't seen what lots of people said was going to happen during this crisis, which is an overall explosion in household debt. That isn't what's happened. But at the bottom, particularly those with children, that is what we should be. That is the legacy of the pandemic, people having weaker balance sheets if they were poor on low incomes.
And finally, Tom, should the government focus on measures to ease the cost of living burden on poorer families? And if so, what should they be doing?
I think obviously if you have scarce resources, you always want to target them where the need is greatest. And so if you're faced with vulnerable people who can't turn on their heating or whatever, or who have real holes in their household budgets all of a sudden, then I think that's naturally where you focus. I think that there, and we sort of may come onto this in more detail, I suppose, but there are a range of things being talked about to deal with energy bills: price stabilisation mechanisms, changes to the warm homes discount, tax changes, and so on. I think what I would be wary of in any kind of response to a cost of living issue like this is doing things that take policy in the wrong direction in general. So doing something that you wouldn't want to do in ordinary times, but doing because it's an emergency, when there is a simpler option available. The very simplest option is often just to give people a little bit more money to see them over this sort of particular hump in the road. But I do think, and I just sort of go back to my previous answer, that this isn't only going to be felt by the very poorest. That's obviously where the political response ought to focus. But I think very many middle-income people will also struggle quite a lot with the kind of rise in bills that they're going to see. And so I think that there will... basically what I would expect is a response from government which is weighted towards the poorest, but isn't exclusively targeted towards the poorest. I think that they will want to have a slightly broader response. And I think that probably is appropriate.
Thank you very much. Thank you, Chair.
Thanks, Siobhan. Can I just, Torsten, come back to you on just one point? So we've talked about the increase in fuel prices, we've talked about the NICS change, etc. But if you were to look at working households of low income, and you were to focus on those two aspects, you would say that the fuel, for the reasons you've given, would be very painful. National insurance, of course, is at least progressive to the extent that there's a threshold beneath which it's not paid at all. And then if you were to bundle in two other factors, one, the increase in the national living wage of 6.6% and the UC taper reduction for those that are working and receiving UC, how do you see those factors working together? And could it be the case that there are some actually in the lowest income bracket who are not as badly off as others, or as we might like?
There will be, as I said, there's a lot of variation here. If you have a very well-insulated house with a really good boiler and you are low income, let's leave the earnings bit aside for a second because that complicates it, but you're low income but you are working, and maybe you're earning kind of £20,000, then the taper rate reduction that happened in early December will make quite a large difference. So the biggest winners from that would benefit by about £1,800 a year.
So are you saying that there are a number of people, a sizable number of people out there who are working, receiving UC, earning 20,000, who might actually not be worse off, even when you take into account fuel increases?
There'll be some individuals, yes, in the maybe mid 20,000s who will the combination of the increase in benefits from the universal credit taper change and the increase in the work allowance will be larger than the increase in their energy bill and the increase in their national insurance payments.
Have you done any work on assessing the numbers?
No, although I can give you a ballpark, because if you think about the population who are on universal credit and you compare people losing the £20 and take into account the taper rate cut and the increase, so the takeaway and the giveaway together, then around 3/4 of universal credit claimants will lose out just from that change, and a further quarter will be winners, and they will tend to be higher income working households. And then within that quarter, you've then got a spread, whereas those who only benefited a bit, say if you think about it roughly, about people that only benefited by up to, say, £1,000 from that change, those people will probably have that all taken away from them in higher energy bills and in the national insurance rise, and so you'll have a proportion of the quarter who will be still net winners. But overall, I'm afraid, Chair, the answer is 2022 is going to be rubbish for everybody, and that is going to include those on universal credit. It's going to be particularly grim for those who didn't benefit from the change because they're out of work or on very low earnings, but there will be a
would be among the least troubled. Not that everyone won't suffer something from inflation, but in relative terms.
It's very poorly targeted.
Very poorly targeted, certainly at the pain that will be experienced by the rises in the cost of living, yes. And, for example, some of the very lowest earners and pensioners would get nothing from this, but they would include...
Because they're not paying national insurance in the first place.
Exactly. But they would include some of the groups who would be most hard hit by something like an energy price rise. So as a target, it would seem a very oddly targeted measure in terms of providing relief against those cost of living changes. I think that would be the first point I would make. Then it's a bit more of a sort of political economy point, but I think that the concern is real about if they delayed it now, would they ever be able to implement this increase? Obviously, they have. The government has decided, for some good reasons, that it needs more money to pay for these pressures in the health and social care system. It legislated these two things together from the outset: the tax increase and that spending. And so, if that link was broken at the first opportunity, I think there would be a real concern about whether in the future it will always be possible to find a reason why now isn't the right time. And once that link has been severed, will it ever be seen as strong again? So I think those would be my two concerns about that measure.
Coming to Torsten, I think you're on the record to say you would have preferred income tax, and lots of people have said that rather than national insurance. But that's,
all sensible people think that.
Yeah, that's not the debate we have at the moment, because we've legislated for the national insurance rise. The question is whether it's an effective measure, effective use of £12 billion to postpone that, or whether it's better to do something else.
It's definitely not 50% of more than 50% actually, of the savings from a national insurance delay would go to the top 20%, and it's the bottom 20% whose energy bills are about to get hammered. So that isn't a good policy given the world you find yourself in.
And what about the political economy point that Robert, given the Chancellor does have to worry about balancing the books eventually?
Well, I mean, look, you'll know better than me, but I hear rumours that it's harder to put up taxes just before an election than it is 3 years out from them. So if those rumours are true, then maybe you want to do it now, not next year.
I've never heard that.
Okay, well, I don't know. But I mean, as I say, you're all the experts, but I hear it can be difficult before elections.
Coming to Tom then. So on this question, would you delay the increase in national insurance?
You'll finally get some disagreement on the panel, because
Excellent.
I would, without question.
Would delay it?
I would delay it. It strikes me as extremely perverse to be raising taxes on ordinary earners in the middle of a cost of living crisis. And now, if the essay question is, as you framed it, is this the most efficient way to spend £12 billion to alleviate the cost of living crisis? The answer is obviously no, I have to be honest and say that. But I'm not sure with respect that's the right framing, because this is a tax increase which hasn't taken effect yet. To not increase taxes and call that spending, to me at least, that's quite a strange way round of looking at it. I think the simplest thing that any government can do if people are struggling financially is to take less of their money away from them. I think that, and I know I come from a particular political standpoint, but that ought to be where we start, and then we talk about the other options afterwards. And I think it's worth noting here that, throughout the coalition and the sort of Cameron eras, real wages were real take-home pay was really kept afloat by the persistent increases in the personal allowance. Now, if we're moving into a world where maybe real wages still aren't going to rise very much, but taxes are going to go up and up and up, that's a very worrying one. It's a worrying precedent to set. Now, there's the broader question. So the thing I'll say is that I understand the politics of it, but for me, the justification that was given sort of in the Sunday Times article, that this is needed to pay back COVID debt, that we must raise this tax now to clear the NHS backlog, it just doesn't hold up to scrutiny, in my opinion. Now, you don't need this tax increase for the Chancellor to stay within the fiscal rules that he's imposed on himself, it seems. But even if you step back a little bit from that, you definitely don't need this tax increase now to clear a one-off backlog from a pandemic when there's still plenty of demand for UK government debt. Now, I'm a fiscal conservative, I'm a fiscal hawk, but saying all of those things, to me, if you've got to clear the NHS backlog, which has come about because of COVID, a relatively trivial amount of extra borrowing rather than a tax increase is the way to do it.
One-off thing.
And then I would look separately at the issue of how do we specifically help people who are going to be hardest hit by this cost of living increase.
You mentioned the personal allowance there, so this was the second wave of my question. Since you raised that, I'm going to start with you, then go down the other way. The Institute for Government said that argued that it would be better to cancel the freeze and personal allowance and the higher rate threshold. Obviously, the Chancellor said he would freeze it for the end of Parliament. It'd be better to do that than to reverse the national insurance contribution rate. It is a huge measure, obviously. So by 2025, it will be £13 billion a year with the higher inflation rate now, savings. It's as much per year as national insurance rates. Do you think there's an argument for reducing the fiscal drag?
Yes, basically, is the simple answer to your question. I know that it would be unfair to call this a stealth tax because the Chancellor did say pretty explicitly what he was doing when he stood up in the House and
determined to announce it as
it.
high volume as possible in the budget, so people couldn't accuse him of doing
Right,
it secret.
exactly. But nevertheless, it is a sneaky way to push people up the tax brackets over time. I think as a general rule, we should just stick to indexing everything that's in nominal terms in the tax system and in the benefits system, and those things should just rise automatically. Because whether this is a stealth tax rise or not, in this particular case, this has been the method of stealthily raising more tax revenue for a very long time. And now if the art of taxation is that old saying about plucking the goose with the least amount of hissing, I totally understand it, But it does seem slightly dishonest. I would rather that we had, if we say we need more tax revenue, people are going to have to pay more tax. And there are plausible reasons why that might be the case with ageing population and pressures on the welfare state and stuff. Well, let's have that debate and let's design a tax system that can efficiently raise more revenue rather than doing it in a sneaky way.
So in short, you would cancel the freeze in the allowance?
I would, yes.
Torsten?
That's not going to happen. To state the blind and the obvious. Look, on the distribution of it, it's more equal than the national insurance rise is. If you cancelled the freeze, it's more equal
right
across
up the income scale.
But it's still top heavy compared to overall. And if you think about it, it's quite expensive for what you get. So it's £3 billion if you went ahead with. It would have been a 3.1% up rating, if you'd gone ahead without the freeze policy. That cost you £3 billion to put that back in place. that would get the basic rate taxpayer about £75. That's not going to cut the mustard for a £700 energy bill rise. And as I say, it wouldn't be well targeted at the bottom. Remember what I just said, as the chair was raising, there are some lower earners who maybe are better off because of what's happened to universal credit, but there's a really big distinction here between the higher earning universal credit households and the really poorest who had a really tough time. And this obviously does nothing for people who are having to deal with that tough situation. So I think it's not well targeted, even if it's slightly better targeted than the national insurance rise. It's not going to happen because the politics are nowhere near as toxic as they are for the national insurance rise. And in the longer term, it isn't actually true that we've been... what's the longer term? It's that we've been having significantly above indexing of the personal allowance over time, leading to... And in the good olden days, Conservatives would have worried about a stakeholder society where everyone was contributing a bit towards paying something towards taxation. Now, obviously, conservatism changes over time, but you might want to think about that. So overall, I would say it is not going to happen. It isn't a good way to target to deal with this particular cost of living crunch that we are facing. I'd say a separate thing, which is... makes me sound like an old Treasury civil servant, but on both of these changes, you're raising national insurance and on the personal allowance change, it's still possible to make the change, but it's now late enough that you're heading into logistical difficulty. So loads of POA companies, payroll companies, will now have set themselves up for April. So you are going to be in a world of pain. Some people probably would end up paying the wrong tax in April. Now, that's overcomable, but you're already... If the Prime Minister was going to tell the Chancellor that he'd change his mind, then last week was his chance, both substantively for the logistics system and politically, because, that was when the moment of greatest chance was. So I think we probably are where we are now.
Robert?
Yeah, so on the targeting, as has been said, it wouldn't be a lot better than national insurance. So it still isn't an obvious response to a cost of living crisis for largely the same reasons as before. I would say a couple of things. I think the argument that it could be advantageous when you factor in the sort of feasibility of it only being a temporary measure, there's something in that, in the sense that I think if the government actually did go ahead with uprating the tax thresholds this year, conditional on that happening, I think it is more likely that it would be able to freeze them in a future year than that it would be able to raise national insurance.
Although we are already freezing them next year.
We are already freezing them for several years.
Can't freeze them again.
That's true. You can freeze them for a bit longer, but in a way that's a slightly funny argument, because by the same token, the government probably wouldn't. The reason for that is that increasing thresholds or freezing them isn't a very salient thing, and so that equally the government wouldn't get a lot of credit from uprating them now, arguably, although again we're into politics, which isn't my thing. But the last point I would make is there is in some sense inflation itself, which is the driver of many of the problems we're talking about in terms of the living standards crisis. Inflation itself getting higher than was expected has made this policy bigger than was actually intended. And I think that is a relevant thing to point out. So from that perspective, there would be some coherence in the government saying, well, hang on a minute, when we set this policy, we expected an X% real cut in these thresholds. That's what we wanted. So let's do that. And that would actually imply a bit of a nominal increase. I think the wider lesson there is it would really be a lot better if the government set its policies in real terms and said, if it wants to increase thresholds by inflation minus 2%, say that, rather than making the real change end up being dependent on an unknown future rate of inflation. I think that's really the issue that we should tidy up. The governments keep doing that.
Yeah, I think that's a theoretically impeccable response, but I think politically it's easier just to say freeze it. But, anyway, that's all my questions. Thank you very much.
Thank you, Anthony. Kevin, please.
Good chat. And this is probably pretty rich coming from a politician, but I would like you to answer this question with yes or no. If you had £2 billion to throw around and you were Chancellor right now, would you cut VAT on energy?
No. Raise benefits.
That wasn't yes or no. So no. Yeah, no.
No.
Okay. Torsten, raise benefits. What would you do instead?
If you've got something in that kind of ballpark, then we should be at the easiest way. Our top priority has got to be helping the poorest households through a very large and very overnight and very. I think it's really important to understand that this is really unusual. Other countries are not having this overnight as much, which has been good for the last 6 months for us, but it's about to become very bad, and we haven't had this in the past either. So it's going to be really acute in April. Not everybody, but lots of households all at once in April. And so the top priority has got to be easing that for poorer households. By coincidence, obviously our annual benefit uprating does also happen in that month, and that is by far the most efficient way of targeting money towards the poorest households, and so increasing the uprating is the way to go about doing that. If you're not prepared to do that, then you will need to recreate that policy, but you can call it the warm homes discount if you want, and you can do it through the energy suppliers. It's just a more complicated way of achieving the same result. I mean, really quite more complicated, so I would prefer the benefit system. But either way, you've got to get hundreds of pounds to the poorest households in April.
Hundreds of pounds. VAT, I understand, would cut about £100 off a typical bill. Hundreds of pounds. How many £100 could you get in your scheme design to those people?
Well, you can flex it in terms of targeting. If you give me a bit, I can tell you the answer to that, but not off the top of my head. But it is going to cost you billions to get low hundreds of pounds to.
How many billions?
I will tell you, but it will be in the 4 to 5 billion to get a significant sums of money.
Tom, you made a point earlier when you said about giving people money to get them over a hump in the road. But in your policy design, the difficulty with that, and I'll challenge you when you come back on it, is, of course, that's difficult to take people away from people when energy prices fall. How are you going to cover that one? As is the case with universal credit, which was supposed to be a temporary uplift to help with the COVID crisis, of course.
Yeah. No, I completely understand. I mean, in a way, that is why I would prefer something which was a one-off separate payment. Now, there's nothing to say people won't demand future one-off separate payments as well. But I do think that, we saw this with the universal credit uplift, which was meant to be temporary, but, came very close, I think, to not being temporary, because these things are sticky. And once it would probably be the same, I think, with the warm homes discount. It would be a permanently elevated benefit if you did it that way. And so I think, there have been rumours about effectively sending everybody a cheque, or however you would do it in the modern world. And I think something like that is calibrated to people's incomes, but is separate from existing tax and benefit structures, would be a good way of dealing with that.
One-off payment. Toss, on that point, would you see your solution becoming permanent, as Tom said it would be?
So the answer to your question that I didn't answer before is £2.5 billion to send payments to 8.5 million households who either receive pension credit or working age benefits, universal credit and the like, would cost you £2.5 billion. And then if you wanted on top of that to make some universal payment, then you need to add significantly more.
How much would they get, do you think, in your £2.5 billion?
That's for £300 for the poorest households, targeted at the poorest households.
Would it become permanent?
No, if it was done through the benefit system, it doesn't need to become permanent, because you can deal with that with the uprating next year, because you're basically bringing ahead some of the uprating from next year if inflation turns out to be what we are hoping it's going to be. So no, and similarly through the warm home discount, there's no reason for that necessarily to be the case. I don't think our problem here is going to be, are we going to be able to make this temporary? I think our problem is going to be, are we going to be able to operationalise it quick enough to get support to people when they need it, which is April.
Right, okay.
Yeah, so I would also, for that kind of sum of money that you mentioned, it seems to me that the most obvious thing to do, which is really in some ways just sort of correcting an anomaly, would be to increase benefits in line with something close to the actual current rate of inflation. Because to be explicit about something that I think has been implicit so far, what's happening with benefits in part is that they get uprated in line with a slightly lagged measure of inflation from the previous September. Whereas that doesn't normally matter very much if inflation is low and stable, but when inflation is rising rapidly between September and April,
the September figure being
3.1%, yeah. Whereas by April, inflation could be around 6%, even higher now, I think, given the way things have been moving. So, really, the government's stated intention, I don't think it's much of a stretch, is clearly to keep benefits in line with the cost of living. It's uprating these things in line with the CPI. It's just that it's not really carrying out that intention properly in the current environment because it's using this lagged measure. So I think the way you could frame this, which would also, I think, make it much easier not to get caught in a trap of being unable to make this thing only temporary is just to say, right, we're going to just change the rules now. We're going to, every April, increase benefits in line with a more recent measure of inflation from January or February, whatever is practicable. That would solve a lot of the problem in the short term. And it would automatically mean that next year benefits would, the uprating would be lower than it would otherwise have been because when inflation's falling back, the opposite would happen. Benefits would go up by less than they would have done under that change.
It is
so
worth
I think
saying on this that the logistics of that have gone from being impossible to being a lot easier because of universal credit, where we can turn things around in a month, whereas in the old days it was 2 months plus at the absolute minimum if you destroyed DWP's administrative capacity. So it is now doable in a way that wasn't a few years ago.
Is there a flip side opportunity here for households to consume less energy, get towards our net zero emissions more quickly, on the basis that it's more expensive, therefore I'm going to insulate more, or going to turn heating down, or whatever else it is? Is that likely kind of byproduct to this?
So it's worth thinking about why are energy prices going through the roof. Okay, and the reason they have gone up so fast is because it is a product that is not very price sensitive. Yeah, it's that if the price has to go up loads to have any effect on the amount of it that gets consumed, whether that's by industry or by households. And so for that reason, even the most ardent of climate change activists should be nervous about seeing it as a really good thing that some people will reduce their consumption because of this very high increase. This is not the area where you should be aiming to do that. The way we reduce our household consumption of carbon emissions via our heating systems is to change our houses and change our heating systems, not to think that you do that via... Now, within the margins, over longer time periods, yes, the relative price in gas and electricity is something we should be looking at, particularly in terms of how we levy levies on our fuel bills. But in the short term, I would be very nervous about anybody telling the public that there's a silver lining to this nightmare, and it's that they might all consume fewer carbon emissions over the coming months.
Any additions to that, or would you agree with that?
I mean, I agree in the short term. The one thing I would add is that this is precisely one of the reasons that I wouldn't want the government to get dragged into a long-term situation where they're subsidising people's energy use. And if you think of something that has been mooted, an energy price stabilisation mechanism, I think it would be very easy for the government just to be dragged in by this crisis right now to permanently try and keep people's energy bills lower than they otherwise would be. Long-term, that clearly means people don't have as much incentive to upgrade their boiler, make their houses better insulated, and so on. So that's something to avoid. But short term, I think Torsten's right.
Another element of VAT policy, we've got obviously the hospitality rate of VAT going up in April to full 20%. Is that the right thing to do right now to a sector that still only 59% of businesses are full trading activity? Robert?
Yeah, I mean, I guess again, there's a bit of you can sort of argue about the past here as well, and I think, I can see there might have been a pretty good case for additional support in December, when, in particular, when they weren't shut down formally, but clearly demand was massively affected over that period. So it's a little difficult in that sense, in that I can see the argument that something more should have been done then. Doing something retrospectively now, though, I think it's a lot less clear to me that keeping VAT lower than it would otherwise have been as some kind of retrospective compensation for that is a good idea. In part, just because again it's a bit of a targeting point as well as anything else. That post-April VAT liability isn't going to be a good proxy for how much a business struggled to survive as a result of what happened with Omicron. So that's why I don't think that would be I think that would be again a slightly strangely targeted measure.
That should just come in. You think?
Yeah. Sorry.
Do you want to go first? It's not a priority. The priority is to sort out poor households' energy bills.
Okay.
Yeah. I think I'll make the more general point that we always reach for VAT as a policy tool, and it's a little unfortunate because I think that if we want to have a more efficient tax system which can raise more money over the long term, carving out bits of VAT, different rates, exemptions and so on, that causes a big problem. VAT in theory is one of the most efficient taxes we have, and so while I understand the sort of short-term pressures there, I would rather look for other ways, if we have to help hospitality, of helping hospitality in the short term, that maybe don't undermine the tax base in the longer term. And the same goes for energy as well, frankly. That's sort of behind my answer there.
Thank you very much.
Kevin, thank you. Alison, please.
Thanks very much, Chair. I've got some further questions around the benefit system and changes and things that could happen there that would help. And I just wanted to ask, because it was announced last week about the DWP's proposals for the Way to Work plan. And Torsten, I think you'd said that it focuses on a problem that doesn't exist. And I just wondered if you had any further thoughts on the impact of this plan on people.
So the bit of the plan that has been given most attention is the earlier application of sanctions to people that don't look for jobs outside of the sector they've previously worked in. Yeah? And bringing that forward within the 3-month period of your claim to universal credit. So the reason why this is not a big deal. So the row was focused on is it not desirable to apply sanctions to people early on in their claims. I think that is slightly a red herring. Although people, the idea that in general our system doesn't apply sanctions early enough is an odd reading of most of the academic literature over the course of recent past. That doesn't mean there isn't a role for sanctions in a benefit system, but applying them very early in a claim is not a strong argument for that at all. But the reason that is a bit of a red herring, the real issue is that we don't have a problem with people flowing off universal credit reasonably quickly within the first 3 months of their claim. We have a different problem, which is that we have about an increase of around 500,000 people who are not looking for work at all, i.e. are not in the labour market. That is what DWP's policy needs to be focused on. Those are largely older workers of either gender and younger workers who are men. That's where the problem has come. We've seen an increase in female participation but amongst younger women, and that is where DWP's creative thinking needs to be focused, not on the relatively small number of people that are on universal credit for just a few months. There's no problem there.
And do you think that those people, because they've lost out in the universal credit uplift, they're not going to be affected by the taper rate changes? Is there anything really for that group of people that the DWP have kind of left behind in all of this?
So DWP has announced some kind of hardship funds administered by local authorities for people who really can't cope on very low incomes. You'll all be seeing that in your areas where people are doling out funds. That as a way of administering support is not a very good way of going about it. But there has been a package of support. I can't remember the exact number off the top of my head, but I think it's around £500 million that the Treasury has announced. So there is some support there through hardship funds. But as I say, for the majority of out-of-work claimants, universal credit has become a much less generous benefit. And I think it's worth stepping back and thinking, where does that... if you look at the whole last 30 years of benefit policy making, partly intentionally and partly not intentionally by both parties of the government, where we've ended up is with a system that's not overall much less generous than other similar European systems, but is far less generous for out-of-work households, particularly those without children. The average level of universal credit for a single adult out of work now is about 15% of average earnings compared to double that back in the 60s. And so that is why you end up with real destitution levels of income support for people falling out of work. And in that context, the idea that the big problem is that they need to be sanctioned quicker is slightly missing the point. And it's not really, it's not intentionally, but if you look at what the universal credit changes have done over the last 6 months, what they're doing is slightly reducing in-work poverty, but significantly pushing up out-of-work poverty.
Thank you. And I understand that your Louise Murphy has a paper out today on young people. Is there a particular bit of work that needs to be done with that group? So
if you look at young people, I'd say, so overall, the first thing is to say young people have been on a complete roller coaster over the pandemic. So by far the hardest hit by the crisis in terms of who was furloughed or lost their jobs or didn't get a job in the first place. So, very high rates of labour market effects. They've then, the positive bit of the roller coaster is that the existence of the furlough scheme, plus lots of them going into further education, back into full-time study. We've seen a 3 percentage point rise in study, has meant, and the fast return to the labour market, has meant that we haven't seen the high youth unemployment that many of us were worried about when we were talking about an early end to the furlough scheme. So that is really good news, and that's very different to what happened after the financial crisis and after the 1980s and 1990s recession. So that's the success. I think the danger is then we say, oh, well, that's all brilliant. If we now look at what happened to the young people that fell out of work and went back into work, the things that we were flagging that we should be focusing on are, one, that we're seeing they're much more likely to be going back into insecure work, atypical contracts, than their counterparts who didn't have that experience of being out of the labour market during the pandemic. We have seen an increase in inactivity even taking into people who are neither in work nor in full-time study, that number has gone up. It's particularly gone up for younger men. So I think there's a 50,000 increase in the aged 18 to 24 men in that position, and we should be worried about that. If that becomes ingrained, that is a longer-lasting challenge for us. So I think our message should be the big picture aggregate outcome for youth unemployment was nowhere near as bad as we feared, mainly because the furlough scheme was maintained, but also because we put people in education and because the reopening of the economy was quicker than we expected and young people benefited faster than other age groups. That's the good news, but we mustn't think that it's job done.
Thank you. Switching to slightly the other end of that, Robert, the IFS have got some work out on the impact of the increase of the state pension age, and that seems to be impacting lower earners who then work longer. Are there particular implications for that group, and is there more that the government could be doing to support them?
Yeah, I mean, in some ways, that kind of group around the margins of the retirement age is, or at least a subset of that group, have been amongst the most hard hit by some of the things that have happened recently, because in part because of these policy changes, which mean that you have to wait longer to get your pension age support, but also that sort of interacts with the fact that the gap between the support you get from the benefit system when you're working age and what you get when you're a pensioner is just huge now. It's more than double in terms of the basic support, ignoring things like children if you're above and below state pension age. So there's a really big gap there. And during the pandemic, to bring it back to some of the labour market trends we were just discussing, during the pandemic, the oldest workers were actually among the most likely to leave employment, and among the least likely conditional leaving employment to go back into it, which relates in part to some of the inactivity trends we've been talking about. So I think that is a group worthy of some of our concern. They get a little bit lost sometimes because there's rightly so much focus on young people, which I think is fair enough as well. But I think that group just on the margins of retirement have had quite a difficult time in some ways. Yeah. And WASPy women particularly, I suppose, of that group who've not been able to retire when they expected to. Mm-hmm. I've also got a question about the sort of impact of increases in the minimum wage, and does that particularly have any protective effect for low-income households, or is it more complicated than that?
I think there's lots of research by us and others showing that the households that mainly benefit from the minimum wage are the middle and the just below the middle broadly, although there'll be households in the very richest part of it. There'll be second earners in really rich households, and there'll be some single earners in some poorer households as well. So it will be spread across the income distribution, but it will be concentrated in the middle and just below the middle broadly.
Thank you. And Torsten, you've talked about some of the difficulties of expanding or changing the warm homes discount in response to the rise in energy prices. You said benefits would be easier. Could you talk us through just why fixing the warm homes discount would be more difficult?
Well, the simple answer is because it's not a system made to achieve this, particularly at short notice. So the warm home discount, £140 paid to certain households, basically poorer pensioners automatically, and then if you claim it for some poorer working age households, but often with a quota system operated by the energy companies.
Quickly on that, Torsten, how many are receiving?
Currently receiving it, that's a good question. It will be in the order of 2.2 million low-income households receiving it.
And if you were to extend, so
you need to get, you've got to get up to, what did I say to you before?
8.5. So another 6 million people for your £300.
Yeah, the system is, so the thing to be really clear about is the current warm homes discount system is totally inadequate to deal with what we need to face in April. So your options are benefit system for ease of it. If you don't like the word benefits for whatever reason, then you're going to have to put really major surgery onto the warm home discount. You're going to have to fund it through the taxpayer, not through energy bills. Because remember, the taxpayer doesn't currently pick this up. It's picked up through the energy bill system. Obviously, higher energy bills is not the answer to the problem we face in April 2022. We need to extend the eligibility significantly and make it automatic. That mainly is about getting it to poorer working age households, not just to poorer pensioners. You might want to extend it to all pensioners as well, depending on who you're worried about. Because if you look at pensioners also have energy as a higher proportion of their spend than other households. And also we've got a timing issue, which is we're going to need this payment to happen outside of the normal warm home discount.
We'd be right in saying that you'd be going from about 2 million people up to 8.5 million. So
you need to more than treble. You need to treble.
Huge expansion in the scope of warm home discount.
You might think from that that using benefits is a better way to achieve the outcome.
Certainly a simpler way by the sounds of it. And can I ask Tom, have you got any particular thoughts on what kind of mechanisms could be put in place changes that could be made to help support low-income families through the benefit system.
Yeah, I mean, I have to say that what Robert and Torsten said about the uprating of UC and using a nearer term forecast or a more recent inflation figure, I think is pretty sensible in the circumstances. I've also said in some of my previous answers that, if there is strictly an issue of some people need some more money right away, a system of one-off payments, you could be looked into. And perhaps it's not something we have as much experience with in the UK. Obviously, in the US throughout the pandemic, that was something that they did quite a bit of. And I think that has the advantage of being straightforward, although there are always administrative challenges, of course, when you do something for the first time, and also less sticky. So it's a temporary solution to a temporary problem rather than something with longer term implications where you might get stuck in a policy that you wouldn't otherwise have chosen.
Thank you very much.
Kevin, I think you had a question.
Yeah, just Torsten, you were saying extend it to 8.5 million households and make it 300 quid, not 150 as is currently. Is that right?
Yes.
Doesn't that mean, so what about the ones, the 2.5 million households now? Are they going to get 450 quid or 300 quid?
I mean, that's the government's choice, isn't it? But the answer is the costings I gave you were for them to get £450. So they've already got. Remember, this has happened. Okay, warm home discounts take place over this summer. They have to pay winter. They have to be paid by the end of March. Yes. So we're kind of done on this year's. Yes. If you look at what loads of companies had exceeded their quota, like back in the autumn, so you're going to have to do another payment.
No, so it's 450 for the lowest income and 300 for the other 6.
450 for some of the lowest income, but mainly pensioners.
And can I just, on that point, the £2.5 billion cost, is that in respect to the additional amount of funding that would go on top of the existing scheme? Yeah, okay, thank you. Angela.
Thank you very much, Chair. I'm going to be asking about renters and owner-occupiers, because obviously housing costs are a huge issue for anyone trying to balance the household books, and quite important to be able to keep up those kinds of payments and keep a roof over your head. So in general terms, what effect will the current inflationary environment have on housing costs for renters in the social and the private sector, and also what about mortgage payments? Torsten, do you want to start us off?
So there's a number of things going on here that I focus on. So it's worth doing what's the longer term context and then what's happening right now. So the longer term context over 20 years is that owner-occupiers' housing costs have been falling, driven largely by falling interest rates, but also by the move amongst that population from mortgages to outright ownership. Yeah, so there's lots more old people own their homes outright, fewer mortgages, not just because you can't get a mortgage in the first place, but because you've paid it off. Yeah, so overall, owner-occupiers' housing costs coming down, great. That's why lots of people don't feel like the last 15 years has been a cost of living catastrophe, even though it has been a cost of living catastrophe. Yeah, because if you had a large mortgage and you saw that fall over time, you're the winner from the last 20 years. The biggest losers on housing costs have been in the social rented sector. Generally, if you look at individuals, because social rents have gone up by more than private rents, and in particular because housing benefit levels have been become less generous over time. Okay, so that's amongst private renters, the main problem has been the move towards having more private renters, as both other sectors have shrunk, and because it's a higher cost sector overall, that has given us higher average housing costs, even if somebody within the sector hasn't seen huge rent rises. There's quite a big regional difference there to think about, which is London was consistently seeing above average rent rises for most of this century, but since 2016 and repeated during this pandemic, that has reversed. So actually now it's London that's by far at the lower end. In the very recent past, Northern Ireland appears to be seeing the fastest rent growth, but London is now at the extreme of having basically no rent increases going on, while the rest of the country sees moderate 2 to 3% rent increases in the private rented sector. So then focusing on the right now, the social sector is the big priority, I think, because what's happening there is that having cut social rents between 2016 and 2020, 1% fall a year, we're now operating a policy of allowing rents to go up by CPI plus 1. That means the rents will rise by 4.1% in April and remember, just under half of social tenants don't receive housing benefit. So they won't get this covered by the state. That group is going to be particularly bad hit. If I was running a housing association, I think people should be thinking really hard about whether they are using all the headroom in that. That's what the government allows housing associations to do, but they can choose what rent levels to increase. And given what their social purpose is, there is a trade-off here. No one wants to pretend it's easy for social landlords, but I would be thinking really hard about whether I should be increasing rents by 4.1%. That is definitely not going to happen in the private rented sector this April.
And what's happening in the private rented sector?
It's about 2 to 3%. I'm looking at the latest figures here. As I say, 0 in London and highest in Northern Ireland, which is about 5%.
There's quite a big regional variation that isn't always picked up in the figures. Does that have well, obviously it will have implications for the so-called levelling up agenda?
On rent, it's broadly, if you take out London and Northern Ireland, it is broad. All the other regions are broadly in the same kind of ballpark. Wales is particularly low increases. Scotland's also a bit above average, but as I say, Northern Ireland stands out for very large rises.
And with current homeowners who, obviously, Torsten, you've just explained, have had it reasonably easy in the last period. We're now going to see rising mortgage interest as we're expecting the Bank of England and the interest rates to go up. What implications do you think that has for those that have got mortgages?
So the short-term effect, so overall what's happened is that the way in which monetary policy feeds through to the economy has become less focused on mortgagors over time, partly because there's fewer homeowners. Within that, there's fewer mortgages, as I just explained. Within the fewer mortgages, there's fewer variable rate mortgages because everybody gets a fixed rate mortgage.
Rise of the fixed rate.
Right, so exactly. Fixed rates have now gone up on the mortgage side, even though they've just come down through the floor on the energy bill side. And that means that the immediate hit from interest rate rises is lower than we would be used to. So this is not the mid-90s, and it's really important to understand. But so I think that's the good news for the mortgages. The bad news is that if you look at what is happening in terms of expectations of interest rates, the change is really quite fast. So if you go back to March last year, markets were expecting us to get only back to 0.5% interest rates by kind of 2026, 27. Okay, so basically hardly any rise. By September, that had come up to 0.75, and it's now over 1.5% interest rates expected basically pretty soon. Okay, so the split now, I almost think looking at what markets are expecting from the Bank of England this year, they maybe have got overexcited. So they're basically expecting us quite large, in the short term, tightening cycle over the next year. Whether or not that happens, that definitely is for the subset of people for whom that will affect them. It's bigger than you would have been expecting it to be in the autumn. But historically, this is not 1992. We're not going to be seeing huge rises like that. But remember, for a handful of people with large mortgages that are variable, those people are more exposed just because the scale of mortgage debt is higher. The flip side of low interest rates and therefore high house prices is for those that do have them, if they're recent purchases in particular, they could be exposed. And so our anxiety should be focused on a subset of that population. But again, the numbers I've just read out to you on the levels of changing and expectations of what happens to interest rates should also make us honest about the uncertainty involved in predicting what's actually going to happen.
And Tom, because of the fixed rate, do you expect these rises for those particularly who've just got mortgages to be held off until the other causes of the cost of living increases have kind of subsided, so the fixed rate, the presence of fixed rate will actually help smooth some of these cost rises out, or not?
I think so. I mean, that's very plausible. You've got 3/4 of people of mortgages that are on fixed rates. And so, I think that seems likely to me that would be the case. I think the bigger issue here, and Torsten has given a sort of brilliant answer about the short-term pressures, but if you zoom out a bit, we're talking about the cost of living. Housing is the single biggest long-term cost of living problem we have in this country. It's really extraordinary. And it's not just cost of living, it's also a massive constraint on the performance of our economy. And so energy prices, we've got some short-term issues. They probably will subside. Things will change. Housing is an issue that just looks to be getting worse and worse and worse in this country without any meaningful change in sight.
Because shortages, therefore, increasing the cost and meaning that's out of range for most people, which means that they're in the more expensive private rented sector, which generally is lower quality. Is that what we're talking about?
100%. That's right, yeah. Great for people who've paid off their mortgages or they've seen their mortgage rates tumble, but the ladder has been pulled up behind them. I'm not saying they pulled up the ladder, but that's effectively what has happened. And so I think when we look at cost of living pressures longer term, this is the number one thing we could do to make people's lives in this country more pleasant, more comfortable, and to make them better off.
Paradoxical, is it not, that having a roof over your head is probably most people would see as a necessity, and yet it's so rare that the price has been going up? What sort of policies do you think might be the best response to that, rather than the short-term dealing with a cost of living increase, which is really about scarcity of supply?
Yeah, and I think the very fundamental thing is you have to be able to build more homes where people want them. And you can do that through top-down reform of the planning system, and it's been tried various times. I'm not sure people have tried hard enough.
But it doesn't seem to be getting very far.
No, it doesn't seem to be getting very far. And, I think that it's quite possible to say that structurally, political economy reasons, we're just not going to achieve that. And so we have to look at alternatives. I think one of the things that's very promising is this sort of radical decentralization of planning, almost to a street or micro neighborhood level, and effectively letting people vote to densify the streets they live on, build more stories on top of their houses. It's the street votes idea that Policy Exchange and various other think tanks have talked about. Then the reason that works is because it would be massively in the financial interests of those homeowners to allow the densification of their neighbourhoods if they could vote for it. And so I think that that's one way around the hard political economy problem we have of people just not wanting stuff to be built near them. But it's certainly not easy.
Anything to add, Robert? You've been terribly quiet.
I suppose one other point that springs to mind that could be relevant in terms of impacts of what's happening at the moment or in the near future on housing. One relevant thing would be is if it affected the price of housing as an asset, because that's one of the really big distributional issues that we've seen in recent years, particularly between generations, because the price of buying a house has got so much. So there, at the moment, I don't think there's much sign that what's happening in itself would have a big additional impact on that. And I say that because long-term expectations of real interest rates haven't changed very much as yet. That would be something which, if it did change, would affect asset prices, like housing. But it hasn't yet, but that's just something to keep an eye on.
Torsten, I mean, we've been through a period where interest rates have been pretty close to the floor. People have got used to having big subsidies to get on the housing ladder, those that have been lucky enough to. Very few people are used to the thought that their mortgage might go up in cost. Are there things that we can do to try and smooth that out, or do you think we should be more interested in dealing with the problems in the social rented sector?
So I think we should. There's a number of aspects. So I think, again, stepping back to the big picture over 40 years, housing cost is basically all about. Most housing cost issues in the UK, taking the population as a whole, are about the late 80s and the first half of the 1990s, okay? When housing costs basically are bubbling on in a nice, regulated but low-quality world, and then basically shoot up. You should definitely, a chart of it is almost unbelievable when you look at it. They shoot up, and they basically get to around 30%, and they've sat there ever since. So it's not true that housing costs are ever going up. They're kind of going along, they shoot up, and then they are trundling along. What's then happened since then, so since the late 90s, is big distributional changes within that. So really big winners, existing owners, and really big losers, young people and people in social housing broadly, okay? And so in the short term, you've got to sort your distributional problem, because some of that is about policy choices, okay? It's not, if you can't just remove housing benefit and hope the housing costs go away. That's not how our housing market works. If we want to get the housing cost, not prices, housing costs down, we need to build more houses, and we need to build them in the places people want them. And actually, stepping back, I think as the country becomes richer, people basically want more housing, not less. Okay, so I think there's lots of arguments for building, even if you haven't got lots more households within the population. That isn't just rich people wanting second homes. I think generally people, apparently they're all kind of doing their exercise in their house these days and stuff. So they're all going to be home working, half of them. So I think overall that we need more housing stock, and that will help on the housing cost front. But that is a slow game. Okay, that's do it for decades, have some effect on housing costs. It's not a silver bullet. On on home ownership, so separate these things out, housing costs and home ownership. If you want home ownership up, you've got to solve the distributional problem, which is if you move to a low interest rate world, you move to a high asset value world compared to income, that benefits people that are not credit constrained, buy-to-let landlords, people with cash, people with existing assets, and it harms those who need to buy out of income, young first-time buyers who by coincidence have also had their income relatively weakened compared to those older people. And if you want to deal with that, you're going to have to move to policy options that are currently considered kind of slightly wacky. So you're going to need to be much more aggressive at suppressing demand amongst those older people, and you can do that in the tax system or you can do that via regulation. But give it 20 years, that is where we're going to get to. If we are staying in a low interest rate world, at some point your successors or you in later phases of life are going to be in favour of much more aggressive regulation of who can own which properties and taxes on second homes and on buy-to-let landlords. And by squishing that demand, you will help some first-time buyers, or you directly help first-time buyers. At the moment, that's being done via the Help to Buy scheme moderately and efficiently, but that's what it's trying to do. And you can look at other versions of that, which basically collapses into ways of either guaranteeing lending to people with low assets, to younger people in general, or you're just giving them money. And in the end, if you don't want to do those things, then you're not going to make a material difference to home ownership in this country.
Thank you, Chair.
Thank you very much, Andrew. It started getting quite hot in here, we've noticed. You probably noticed it too.
The breathing.
And we sent out a message, and such is the technology of the House of Commons, that a lady from facilities came in and used a large key to open the windows, which is rather ironic given that we're discussing fuel bills and heating and so on. But can I just say, if you do get a little bit uncomfortable, anyone on the committee wishes to remove a jacket, then please do. That would be absolutely fine. And I'm now going to go to Emma, please.
Thanks very much, Chair. And yes, I am cooking. So I'll wait.
We've got a nice breeze here now, actually. Yeah.
I'll wait until after the questions before I take my jacket off. Afternoon, everyone. Really interesting answers to the questions you've been given. So before I go on to what I was going to talk about, I just want to unpick some of it. You mentioned, Torsten, about making the Warms Home discount automatic. Sort of what are the benefits or non-benefits of doing it this way, of making the Warms Home discount an automatic thing that people would receive?
So if you just look at who is currently getting the Warm Home discount amongst poorer households, it's just not getting to enough people. That's partly because of eligibility, so the poor households aren't eligible for it, but it's also because it requires you to make a claim. Now, what I would say is it's easy for me to say it needs to be automatic. In the world of delivering this, that involves data sharing between DWP and energy companies, so this is not easy at all. Yeah. I don't think there's ways around that. I could imagine DWP being the people sending the letter with the discount to the households, who then let their companies know. So I'm not saying there's ways around it, but it is difficult. And I think one thing that, again, I don't want to sound again like a civil servant, but I do think we need to think about, we've taken quite a while to make this decision on how we're going to help households in April. The longer we wait, the harder some of these options become administratively even harder. Okay, so I think, for example, the idea of sending people cheques is not going to happen by April. I wouldn't do it anyway, but it's administratively not deliverable probably at this point, unless we mean sending it to households just on benefits and DWP doing that. Again, you should just do that via basic benefit system rather than sending them a cheque if that's what you want to do. But there are real logistical difficulties. So I'm sure the lawyers in DWP are currently going all over what data sharing would allow them to do with energy companies, and that is a very significant concern. So it would need to be automatic to work, and to allow a government to take a decision to use that route rather than the benefit system, but that brings with it significant operational difficulties.
Thank you. And because I was just reading this briefing from Citizens Advice, actually, and they were arguing for using the benefit system. And I don't know if you've had a chance to look at what they're proposing, but they've given examples in their briefing of the number of people going to them for help and support. So they're talking about an increase of 123% compared to the same time last year of people going to them for help with their energy bills. I mean, the data is absolutely shocking. I don't know if you had a chance to look at it, but they talk about having an energy support grant through the benefit system. Yeah. I don't know what any of your thoughts are on doing it that way.
So you can just pay. You can pay a lump sum through the benefit system and try and do it that way. I'm a bit cautious. If you're going to do it through the benefit system, then my preference would be to do it through the basic uprating. And the reason for that is because although the energy bill rise is happening in April, what obviously matters is for how long a period you have to pay that higher energy cost, particularly while you are lower income. And so really what you want is to not just give everyone who happens to be on universal credit in April a cheque. You'd be better off paying a slightly higher rate over a period of time, i.e. the year, so that if someone's out of work for 6 months, they get 6 months worth of that extra support, rather than the person that happened to be out of work in April getting it, but the one that's out of work in June not getting that support when they have struggling with energy bills. So you'd be better off doing it via the basic rate of the benefit. But yes, you could also do it as a lump sum payment. But I do think really hard about, you're going to end up with some, if you do this through lump sum mechanisms, then the unfairness between people who are in different situations at different time becomes more acute. But that's still definitely better than doing nothing. And the similar issue would apply probably with the warm homes discount, although you could at least provide a time period over which it would apply. So it wouldn't need to be just on day one. It could be anyone claiming those benefits over the course of, say, 6 months or something.
Yeah, and they suggested the winter fuel payments, doing it similar to that, but applying it to people on universal credit as one of their suggestions. Yeah,
so that's the similar mechanism. I mean, again, anyone that has wrestled with the logistics of the winter fuel payment system will be...
Sorry to interrupt there, Emma. When you say... Torsten, that it needn't be a lump sum just if you were in a particular situation in April regarding benefit claims, but actually if you'd been claiming those benefits for, say, a period of 6 months, how significantly would that impact that cost of 2.5 billion? Do you have a sense?
I don't know off the top of my head, Chair, but yes, you do see a significant amount of churn, particularly amongst the short-term universal credit claiming population. You see some slower rates of churn amongst most other benefits. Over that period, so it would increase the cost if you said you have to be entitled to it at some point over 6 months. That would increase the cost versus the 2.5, which is taking the population as it is on a given day.
Yeah. Anything you can write to the committee on around that would be helpful. Actually,
do some digging on that.
Yeah, thank you. Sorry, Emma.
No, thank you. And Emma, I picked up on something you were talking about, the long-standing supply-side issues. You said that we need to deal with the long-standing supply-side issues. I just wondered if you wanted to elaborate on what those are and how would you try and deal with them?
Yeah, sure. I mean, I think that they're not specifically in energy, which is obviously the immediate crunch. When I was talking about long-standing supply-side problems, I mean, housing, which we just talked about, is one of them. Childcare, I think, would be another big issue where costs are extremely high. And I think largely, I mean, funnily enough, actually, the planning system and the cost of property feeds into expensive childcare. But so do things like staff to child ratios, where we have much stricter regulations than most other countries.
Good. I used to work in a children's nursery. Those ratios are good.
Oh, no, believe me.
Anyone who will pull a 2-year-old and tell me you should drop those ratios.
With an 18-month-old at home, I know. But nevertheless, it does seem like other countries get by with much more relaxed ratios, which naturally tends to lower costs a little bit. I think we've also driven a sort of increasing formalisation of the childcare sector, perhaps without sort of full recognition of some of the costs that would bring along with it. And so I think that informal childcare has massively declined over the course of my lifetime, for example. So the cheaper options aren't necessarily there. The more expensive ones are increasingly out of reach for a lot of people. And of course it helps when government sort of provides sort of subsidies or tax breaks or whatever, but that does also tend to just push up demand, and you tend to see the prices just go up and up and up as a result. I mean, I think that those are two of the particular areas, but actually, it would be very valuable for a government to just sort of do a comprehensive cost of living review and look across the whole range of issues and say, where are there things that we could change policy-wise that would make things cheaper and more abundant for people? And there are obvious ones like housing, but I suspect there are rather more obscure ones as well that kind of review would throw up. I mean, I think, fundamentally, there's a couple of different ways you can approach trying to make people better off. And obviously one of them is to give them more money. But the other one is to make the stuff cheaper so they can afford more of it. And I think that just because naturally, in politics and in policy, you tend to focus on the immediate problem that's in front of you and fixing that, and in most cases rightfully so, but those longer term things maybe get neglected, and so I think they also need a little bit more focus.
Thank you, because it's interesting, not that we're going to start talking about building safety bill, but there wasn't more in that on insulation and on preventing the problem of escaping energy before we get there. But I want to go back to energy. So although there's been obviously global gas and electricity price highs, many have commented that this crisis is particularly acute in the UK, and they put due to low gas storage and the UK's heavy reliance on gas. What do you think the government can do to make the economy more resilient to these external price shocks in the energy market? Anyone wants to?
I mean, lots in the long term. I mean, it is really depressing we've ended up in this place, but I think but it's a long game, and you need to tackle this at a lot of different levels. So like insulation in Britain is a disaster. It was always been a disaster, and our progress on it has been a disaster, particularly after we cut the green crap, which was the technical term for our policy change in 2012, 2013. It's a very big mistake. Okay, look at the rates of insulation for households. Like, people are not going to be doing this without policy support. You're going to have to get on with it, and we've wasted a decade, and we now need to take it seriously. We can't just wait for the next energy crisis to decide the way to get costs down is to not insulate homes. Again, it's a really, really big policy mistake. We've got to crack this. You can make your energy supply itself less carbon dependent, and in the end, the volatility here isn't really coming through wind, although that's causing some of it. It's basically to do with global gas prices. So that's both have more renewable energy. There's really good news. Some of you would have seen the auction that took place about the Crown Estate in Scotland. Really high uptake of people wanting to be able to apply for planning permission to build offshore wind. That's exactly what we need to see on a big scale, nuclear and the rest. And one of the unusual features of the UK energy market is how much of although lots of our energy isn't coming from gas, because gas is the marginal provider, it's moving a lot of our pricing system, and that's what's causing this wholesale price to be particularly acute for us. So we want to think about that element of the system too. To get us to, I think that we have made a mistake on storage about not having it. I think we should be a bit cautious about saying that is everything that is going on, because what having a large amount of storage from gas would do, it would have protected us for a time from these wholesale prices coming through. Okay, but there's no way we would ever have had enough to get us through this whole crisis that's going on. So we should be a bit cautious. That we should have had more of that, but that is not the overall answer to what is going on. Then we need to think about, and that's all on that's basically on the wholesale side or the housing side. You've then got the supply market, which is what everyone's focusing on. So the actual six or old companies now, not as many as they used to be, going bust, and what's going on there. Okay, and the thing we've got there is we've been trying to make competition in this market work for some time. The energy price cap is a recognition that competition, as it was taking place, wasn't working for households that didn't switch regularly. That's why the cap exists. That's why both parties voted for it. There, largely, I think what we are finding out is that isn't the only problem. The problem is that competition within the market, even for people that do switch, the bit of pricing where firms can compete is basically on the risk of their hedging strategies. Okay, i.e. firms that wanted to give you a cheap fixed rate deal weren't hedging as much, which is why loads of them have gone bust, and some of the other ones were hedging for longer, which is why they're going to get in trouble but not as early, and that's why they had more expensive provision. It is not a good idea to be exposing households to that kind of competition, and so that probably means we need to see more regulation about how long firms are hedging for, and require better matching between the fixed term tariffs they're offering and their hedging strategies. But we need to be honest that probably does mean slightly higher prices, but it means much less volatile prices for households, and that in the end is probably where we need to end up. So there's a lot we need to do.
Very much. There is a joke somewhere about lack of wind and lots of hot air in here, but I won't be the one.
I think you can get
I won't be the one to make
for
it.
that.
Tom, can I just ask? There were reports that the government is considering taxing North Sea oil and gas sector and using those funds to subsidise electricity prices. What are your views on that?
I think it would be a mistake. It would be a big mistake, and for a number of reasons. I think first of all, the North Sea oil and gas industry is not what it once was. And I think sometimes these proposals assume we're still 10, maybe more years ago where this stuff was booming. I think sort of 2014 to 19, with the oil price collapse, these have been really lean times for the North Sea oil companies. I think it's not dominated by the major players to the extent that it once was. The margins are much lower. There's an awful lot of debt, as I understand it, as well. And so I think on the one hand, there's this sort of quite fundamental thing that when the problem is fundamentally a shortage of gas, does it make sense to tax heavily the people who are trying to find more? Maybe not. But I think more broadly, you're going after an industry which is in decline, which I think actually if you clobbered it with a big tax bill, you could see a lot of job losses. And the big problem would not be just the short term with damaging the North Sea oil industry as it exists at the moment, but the fact that I think there are quite high hopes for a shift to green energy, that a lot of what's currently going into oil and gas in the North Sea can be repurposed. That will go into carbon capture and sequestration, that will have a lot more offshore wind and so on, in that those same areas, those same industries, the same sort of skilled people who are involved. And I think if you had any kind of tax raid which severely hit those industries, which maybe led to people leaving them, that sort of ecosystem that exists at the moment and which could be extremely useful with the green shift might get broken up prematurely. And I think we've actually seen this sort of post-2014, that a lot of people have just left the sector, seemingly never to return. So I'd be very worried about the longer-term consequences of a windfall tax.
Thanks, Tom. Austin?
I mean, you should get on with it. I mean, let's just step back. What's actually going on? Why are prices up? Because we're redistributing from producers of energy who are either foreign producers of energy or they are some domestic producers, and they're not oil and gas, actually. Some of them are renewable producers of energy who are also benefiting from windfalls. You can decide if you want that the market is delivering with the optimal level of redistribution from UK households to those few companies. If you do, you're a brave person. I see no justification for that argument. Or you can use a small tax to redistribute some of that windfall. You can't get at all the windfalls because lots of them are abroad and you haven't got a Saudi Arabia tax ready to roll, and they're not going to accept one. But within the UK, the idea that there isn't a better solution to the level of redistribution that's currently taking place. I mean, remember, this is not about fundamental changes in the level of supply. This is a straight redistribution driven by wholesale price changes from households to people who already owned the capacity to produce that energy. The idea that you don't want to tax some of that to make it slightly less larger redistribution is beyond me. Where Tom is totally right is to say that the level of revenue you're going to be able to extract via that mechanism, because lots of it isn't taking place within the UK, is going to be relatively small compared to the size of the overall redistribution that's taking place. So you're still going to need to borrow money to do the scale of support to low-income households you need, but you should get on with some of it.
Yeah, Robert, did you want to come in?
Yeah, there are, I think, certainly worse ways of raising money. Well, windfall taxes always have certain advantages, at least in certain conditions in particular, that you're taxing the past, basically, so you're not distorting people's future incentives, at least potentially, as much as you would be with other taxes. I mean, there can be issues if there becomes an expectation that you're going to get windfall taxes every so often, of course. But yeah, you could do. There are worse ways of raising a bit more money. I don't. If I did that, I wouldn't. I don't think I would. I wouldn't spend it by directly subsidising fuel. In terms of reducing the price of fuel, I think, because that comes with downsides too, particularly if it were permanent. Again, we've already talked about the problem long term if we move to a situation where we're actually encouraging the use of these things even more than we were before, which we don't want to be doing long term. So I'd be a bit wary about going down that route. But yeah, on the tax side, yeah, there are worse ways of raising a bit more money.
Thank you. Sorry, Chair, I've overrun. Thank you.
Thank you, Emma. Julie.
Thank you very much, Chair. I'd like to ask about economic growth, and maybe I can come back to Torsten. What do you think the impact in increases in cost of living will have on our recovery as we come out of the pandemic and on economic growth?
So this is like an absolute crucial question, and I don't have a numerical answer for you. I think the things to think about. The governor obviously got into some of this when he was talking to you a few weeks ago. And I think some people were slightly unfairly mocking his comment that inflation might be suppressing demand, and saying that didn't make any sense because it was excessive demand that was causing inflation. I actually think he's making quite an important point, which is it's really when you think about the effect of inflation on demand in the economy, it really matters which kind of inflation it is. Okay, so cost push inflation being driven by the cost of energy, particularly being imported, is just making us all poorer, is requiring households to spend a greater portion of their income on energy, and will suppress demand for other things in the system. So I think he is right to raise that, and that is different to wage-driven inflation from a tight labour market and the rest. So I think we should be thinking about that, and if you're running a hospitality business, you'll definitely be thinking my ability to sell stuff is going to be pressured by people having to pay more for their energy bills over that phase. So I think that is something people should be thinking about. I think that should be seen more broadly, though, and this is why it's a hard judgment. And I don't have and again, anyone who's really certain, I think we should be suspicious of. But this gets into this broader question, which is what is the balance of supply and demand in our economy, given that broadly the recovery has been quicker than we expected in terms of reopening on the labour market side, and it's been, by more than we expected. Expected in the relatively recent past. Obviously, the beginning of the pandemic, everyone was hoping this was all over in a week. But so the labour market's recovered quicker. The GDP is not quite as quick, but still has now got back to where it was before the pandemic. So the judgment call we've got is, here we're focusing on these tax rises and these pressures on consumption from energy bills. How do they fit with the strength of that recovery? In the US, the version is slightly different, which is not about taxes going up, but is about support being taken away. Yeah, and that's now driving. Support's taking away, fiscal support's being taken away, and then rates are rising on a slightly slower than us timetable, but expected to go further. So I think you should see it in that context, which is, do we think the economy is strong enough to withstand the tax rises and the energy bill hits to household incomes, given the nature of that inflation? I think it's a reasonable judgment that there's things are looking that's possible. On the balance of risks, you might, on the economics rather than on the political economy, is it absolutely ideal to be doing the tax rise at exactly the same time as the energy rise at the moment? Probably not, but that's where we are. And so I think, when you look at what makes me slightly cautious about some of the forward markets now on Bank of England rates getting up to over 1.5 really quite fast, is that is assuming basically everything goes smoothly. And there is a lot of other things going on that could make it. And if you look at what's happening to wages, people worrying about a wage price spiral were waiting for this wage takeoff to come as everyone starts bargaining. Average weekly earnings 7% back in the summer, now down to 3.5%. If you look at the survey out from Lloyds this morning, showing firms' expectations of wage rises, we're seeing quite large falls in people's expectations of giving wage rises of 2, 3, 4%. So I don't think that's how firms are responding. I think what's actually going on is that firms are looking at their input costs going up, which isn't just energy, but it's other goods, other things, thinking about how much of that are they going to be able to pass on in terms of price rises themselves. And that's going to be difficult for some of them, but that's going to happen. And then they're thinking, can I make that problem even more difficult by raising wages lots? I probably can't. And so I think that's why you shouldn't be that's why I don't think the evidence right now is pointing to admittedly a tight-ish labour market, pretty tight labour market, but I don't think it's leading to very runaway wages, and that's because firms don't think they can afford it, given what else is going on, given their ability to push up prices. Now, obviously there's a limit to that. If the labour market gets really tight, then workers will be able to demand those wage rises, and firms will have no choice, but I don't think the evidence shows that we're there yet.
Thank you for that answer. So, given the many factors that you've talked about, so can you differentiate between the impact on goods, for example, as compared to services? We've seen during the pandemic when people couldn't go out, the demand for goods actually increased more. Yeah. So as we unwind and recover, what's your assessment of the difference between those two? Could there be a rebalancing?
I hope so, for the hospitality sector, yes. And for everyone actually seeing their friends again at some point. So there's lots going on within that that's going on. So overall, obviously, the rebalancing is what we're trying to see. Now, what we're actually seeing is that the cost input inflation is on the goods, much larger on the goods side, although, which is not a longer term trend. And so we should expect the second round effects to come through largest on the goods side. I'd say, obviously, it is picking up as well on the services side, but it's much lower, which again makes me think we haven't got some wage price trauma going on yet. But it is there. If you look at the difference with the US, and obviously globally what we're seeing is similar patterns within Europe, and then the US being an outlier with higher inflation than the rest of us. That is mainly about goods, although they have got a broader service. They've got higher service inflation than us as well. So I think we should be thinking, right, well, look, this is mainly goods at the moment. We're going to see some coming through in services, so long as it doesn't lead to wages significantly outpacing productivity in a way that the labour share increasing can't deal with, profits being shrunk, then we haven't got a wage-led inflation problem coming through. In terms of the rebalancing, it has been slower than I expected in some ways, and you saw that Omicron has obviously put us backwards on that. But if you look at durable spend more recently, we have seen it dropping back down again after Christmas. So I think people do want to go out and get back into some of the social spending, but particularly on holidays, we're not quite at that point of the year yet. So I think it's a longer game than maybe some of us thought a year ago, the rebalancing you're talking about.
Thank you. Robert, did you have anything you'd like to add to that question? Okay, thank you. I'm just going to pick up, before I go on to Tom then, I'm going to just pick up on something else you said, which is about the way that firms might react. So increasing prices could potentially have a positive impact on productivity as firms react and invest in certain ways to stop passing those costs on. What's your assessment of that possibility?
Yes, obviously the best version here is that there's cost pressure on firms who respond by, and there's some evidence of that in terms of when do firms do things very differently? It's when they're really under pressure. And that's why a tight labour market, which drives wage pressure, is desirable in the long term, because it forces firms to think hard about how they use that labour and to get our productivity up. And big picture, low productivity is the catastrophe in levels terms and in rates of change terms. Now, the reason I'm slightly nervous about some of the more optimistic takes that are out there at the moment about it's all going really well and we're going to have, we came out of this pandemic, we've all learned how to use all this tech and it's going to be really good productivity growth and therefore wages will be able to surge, is that we have invested in lots of tech over this. Well, we invested in some tech to get us through remote working and the rest, although overall investment levels are down. But we have invested in that. That has mainly helped us operate in a world where we were facing new costs. So operating in a pandemic was more expensive, and so we've invested to cope with that world that we were living in. Largely, that's what firms have done. That isn't productivity boosting compared to the world. That's just dealing with that. You've been hit by a supply shock, and you're paying to deal with it. Okay. Now, there is some good news. So there are investment intentions do look like they're up, which may partly be driven by some of the things you're talking about, and that's true across a number of surveys. So I think that's optimistic given how big a problem. And if you said what's wrong with UK firms, not investing is what's wrong with UK firms compared to other countries, particularly France. Secondly, surveys of firms are basically saying we think we'll be basically as productive as we were before the pandemic afterwards. Now, but then they have really wide variation about how they answer that. But on average, it's broadly. So that makes me think, one, that'd be quite a good outcome because there's lots of extra costs have been imposed over this. So if they get back to that situation in the short term, that's quite a good outcome. What it isn't is, everything's been transformed. I can suddenly run this business more cheaply because for loads of businesses, it's got more expensive. So in the short term, we don't see evidence to support the hypothesis that pressure on firms has led them to some new high productivity level. Could that happen, and has that happened from some cost pressures like the minimum wage in the past? Yes, although it also put up prices and cut profits, so it did all three. I hope we see more of that in future. I don't think we should confidently say the evidence currently says we've got a productivity surge coming through right now, and that's going to allow wages to go through the roof. I don't think the evidence supports that.
Okay, thank you. Tom, do you have a comment on that? Are you any more optimistic on productivity, for example?
I try to be optimistic, but it's quite hard when you look at the track record of productivity over many, many years now. I think that your question about the impact of all of this on growth is a great question. It's actually the question we should be asking about almost everything, and I worry that we don't ask that question enough. Clearly, I don't think the cost of living pressures are going to help in the short term. They'll hurt a bit. If they're not persistent and long-lived, then hopefully, the hit won't be a great one. But maybe also think about all the other things that we're doing at the moment, particularly on the tax front, which I think are going to undermine growth. That worries me. And so I think, think about growth with cost of living, but we should think about it with everything, because that really is the huge challenge we face as a country, that our growth has been really lackluster since the financial crisis. That has huge effects on people's living standards. One of the reasons why when you get a cost of living spike like this, so many people are going to be so hard hit because they're not better off in the first place. And I think the tendency is to think, all that growth is something that happens to us, not something we can affect. But I do think there are things we can do, and there are things that we can not do, which would help.
Okay, thank you very much. I'm out of time, actually, Chair. Thank you.
One quick question. One on the point you were making, Torsten, about productivity and companies having extra costs as well as maybe having teched up a bit. But if you take Zoom meetings, for example, the number of businesses now that can talk to lots of people, potentially right around the world, whereas previously they would have had to have got in a car, got on a train, spent a whole day travelling and so on and so forth. And you've got to imagine that maybe without the problems that we faced, which necessitated suddenly everybody logging on to Zoom, so you've got the critical mass which you need in order for something to be an embedded and used technology very quickly in an accelerated way. Would that not be a factor and others which, beyond the pandemic, will yield greater productivity?
Yeah, so I think, look, I hope so. And obviously, lots of firms say they're more productive with doing that, and it obviously opens up new opportunities. You'd have to travel less. That's a cost saving. That all else equal makes assuming there's no detriment to the quality of the discussion, then that should be boosting productivity. Absolutely. And I think we should expect some of that. What I'm cautious about is the idea that that's that's transformational. Because remember, what lots of other firms, in another context, lots of MPs from all parties regularly say to me, like, the real lesson of this crisis is that we need a more resilient economy. Okay, that means more resilient means. Generally, when you push on it, it means in the short term less productive. It means holding larger supply chains. It means paying to have some things reshored in the UK. So I think we should be, and lots of firms have come to that conclusion as well. You'd rightly be a bit weird if you didn't come through this thinking I want to hold a bigger stockpile in case anything bad happens around the world. Well, that is going to cost. So I don't think it's as. I think basically the huge optimists are like talking about just their firm, or they're a kind of bunch of... some of the people talking about that are slightly on the atomised end of the market, should we say. So some people are fine doing their transactional work in their bedroom with their heads down, never meeting another soul, and their work's really suited to that. All I would say is nobody should generalise from their own experience to the entire economy, and the entire economy is not telling us there's some kind of productivity miracle going on. But equally, we shouldn't discount the fact that there will be some areas where we have become much more productive. If you don't need a transatlantic flight to have a meeting, well, that saved you a lot of money, and that's made you more productive in terms of that short-term situation. But if you're a hospitality business right now, you ain't feeling more productive. You've got your tables are further apart. Your customers are more nervous. Yeah, I think we need to be. There are still supply shocks that are going on here that aren't just. The cost of shipping around the world has gone through the roof. That's a really large supply shock to our goods sector.
Yeah, I just guess that there are so many variables, actually, if we discussed them at the beginning of the pandemic. Unemployment, where was that going to go?
Yep.
What was going to happen to growth? How quickly would we bounce back? What was inflation going to be doing? If we were discussing that 6 months ago, where actually we've got it all completely wrong, or largely wrong. So maybe with productivity, we're all going to be surprised in 6 months' time that it's suddenly whacked up through the roof, and then we can all... sort of rationalise it at that point. I don't know. Just a thought.
We should all be the lesson of life, not just economic forecasts, is that humility is a good thing. I agree with that. Absolutely. But just specifically, all I would say is the OBR forecasts already expect productivity to bounce back to 1.3% by 2024. Yes. Yeah? That's what's giving you some pay growth at the end of this forecast period. That is already significantly faster than the productivity growth you saw before the pandemic. So insofar as there's an upside scenario, some of that you may have already had some of it.
Okay. Right, and my next question, I will be very brief because we want to conclude this. On the OBR forecasts from last budget, focusing on borrowing, so what we know is that we've undershot the central forecast by 13 billion for the 9 months up to October, I think, or it might be October, I think. Given that inflation is sort of taking off in a way, as we've been discussing, that many haven't predicted, and interest rates will consequently follow, and that has an impact on the public finances, although of course there's a debate about where the inflation is coming from, and therefore if you're getting wage inflation, you're getting something back because fiscal drags, raising your mortality, all that kind of stuff. Where do you think the balance lies? If you're the Chancellor, at the moment you're thinking, I'm 13 billion better off, that's the good news, but I've got these dark clouds, and am I going to be sitting here in a year's time thinking I'm above or below on borrowing the OBR's forecast? What would your view be of that? And a question to the panel. Short answer if possible, because of time.
Well, product market inflation should be bad from that point of view. It should add to borrowing because it's going to push up different items of spending, welfare spending, public service spending, debt interest spending as well, and as long as the wage response is only limited, is not sort of one for one, which it won't be, this will impact on real wages, then you don't get enough extra receipts from taxes to compensate. So that will be that will be a negative factor weighing down on things, and that has got worse, of course, quite significantly worse in terms of the outlook there since the OBR said what it said back in the autumn. So yeah.
Austin. Overall balance is the Chancellor sitting there thinking I'm okay for now, but actually I could easily end up the wrong side of the central forecast on borrowing
Well, I
in
think,
a year or so's time?
I mean, my cop-out answer is that I think it's the balance of probabilities are that when we come to March for the renewed forecasts, the scale of the borrowing improvement over most of this year so far, giving you 13 billion in October, means that we should come in below forecast for this year's borrowing. I don't think that is very interesting, because if I'm the Chancellor, I'd be saying, well, I've got, maybe it's 13 billion, as you say, or whatever it is, but I've got something in that kind of order of improvement happening this year, but I also probably borrowed 180 billion pounds overall, and the level's quite important as well as the rates of change from a forecast. So I suspect that will be dominating his thinking. And as you say, within that then, what matters is the balance of risks. And the two bits of risk are that inflation is already much higher than the OBR expected it to be, which is feeding directly, because a quarter of our debt is index linked, it's feeding directly into our debt interest costs. If we see the rates rise that the markets are currently expecting this year, it's quicker than I would have expected in terms of feeding through into, because 40% of, because the Bank of England's balance sheet is now 40% of GDP, because of quantitative easing, that is going to feed through. So he would be right to say, I've had some short-term good news, the big picture is I'm borrowing a lot of money. Insofar as that good news relates to the labour market recovering better than expected, actually, and corporate profits. It's basically corporate taxes, VAT and income taxes, I think, are all up compared to the OBR's forecast. So it's basically the economy doing slightly better than we thought pre-Omicron, I have to say. Then the answer to that is that's good news. That's because that doesn't mean you need to spend it. That means you can bank that because the economy's done better than you expected. And then you should worry about what the future looks like, because uncertainty is very big.
If you...
Yeah,
what's been said.
I think the short answer is there are a whole range of different factors, and it's hard to disentangle everything. But the single biggest determining factor in this question is how well does the economy do. If the economy is growing fast, we're going to be in a good position. If we have lackluster growth, we're not. And I think that's the bit that we really need to focus on and try to avoid doing anything that harms the potential recovery. No unforced errors. But if we can, actually, let's try and do some more pro-growth stuff as well.
Very good. Thank you. Rushanara.
Thank you very much. So my questions are mainly about inflation expectations. And we've seen some reports like the Citigroup YouGov inflation tracker suggesting that there's an increase in household inflation expectations. So starting with Torsten and obviously anyone else who wants to come in, what are the repercussions of that happen in terms of increases in household inflation expectations, and how far would it need to go for you to be concerned?
So I think we should distinguish household inflation expectations and market.
I'm talking about households.
So on households, basically, this is being a bit unfair to households, but broadly my view is that household inflation expectations track actual inflation, basically. They're not really expectation measures, they're really just like, what are people experiencing right now? Mm-hmm. If you look at the pattern of that, what's really happening is it's bubbling along at around 3% before the pandemic hits. It falls because inflation heads towards zero in the first year of the pandemic. Remember, it's a bit weird. This time last year, we were looking at inflation rates of like 0.4, 0.5, 0.6%. Okay, so the world's changed very fast. Households have then, if you look at the autumn, which is the last Bank of England data point, you're then back to where you were pre-pandemic, because basically households have seen their inflation going up and their expectations have risen with it. So I think in terms of... are there really worrying signs in household inflation expectations right now? No. On the market side, ours have, compared to the US, have basically, we've gone through a phase where the markets have basically looked around the world, said, look, inflation's at risk of getting out of control. Have now, expectations went up around the world. Particularly in the US, they've now come back down, basically because central banks have gone around saying, I didn't mean it when I said low forever. We're going to be raising rates through 2022. Don't worry, I really mean it. And they have, particularly in the US, where it's a much better macroeconomic case for saying that in the US than there is here, and they've bought that. UK market rates, inflation rates haven't fallen as fast as in the US. but they have started falling. So I don't think either gives you cause for alarm. Broadly, what the markets are telling you is we now believe that central banks are quite serious about this inflation thing if a problem develops. Because these are all like 5-year out, 10-year out inflation expectations. So what they're telling you is that the markets don't think central banks are going to give up on doing their job. Obviously, the flip side of that is they're all expecting higher interest rate rises than they previously were expecting. So I think overall, we shouldn't be too worried. The thing to think about, though, is when we're discussing these wage price spirals, there's two ways of thinking about it. One is, how does a wage spiral happen? Is it workers have inflation expectations and therefore they get those higher wages, because they're bargaining harder because they're worried? I think we're thinking too much in those terms. Instead, you should think about, is the labour market really tight? If it is wages, they will be able to bargain for higher wages. Now, maybe they may be motivated by the higher inflation, but it's not the higher inflation that's giving them the market power. It's the labour market tightness. And so when we're talking to the central bank and thinking about their judgment at the moment, it should be about the tightness of the labour market, not about externally driven inflation shocks. It's all about the labour market.
So the answer to that would be more immigration. What else would it be?
Right now, I've got 500,000 people dropped out of the labour market, and we should try to get them back into the labour market, basically.
But we are. So what's the kind of combination of things that need to be done to reduce the pressure on?
No, so in the medium term, I want the pressure on the labour market. But clearly, when you have got to a labour market at full employment, and you've done what you can to increase supply of people who are already here, then interest rates will return to their equilibrium level, insofar as we think that's the conceptual framework we're using. I think that's a reasonable conceptual framework. Under that basis, the labour market has tightened significantly, high vacancies, low unemployment, and an inactivity problem. That's why it's reasonable for the Bank of England to be raising rates, not raise them above their long-term trend, raise them back towards an equilibrium level, normalising them. I think that's a reasonable judgment to be making. There's then a separate issue, which is like structurally we want to have the highest participation we can have, and that is what policy should be focusing on in DWP. That isn't going to be driven by your macroeconomic policy, except insofar as it's beneficial in general to have a tight labour market in terms of drawing people into activity.
Does anyone else want to come in on that particular?
No, I mean, just to note that I think long-term inflation expectations in that YouGov Citigroup poll, they're at 2013 levels. So while they're high, they're not unprecedented, and I don't think sort of history suggests that we're going to face a serious problem there.
Okay. So if interest rates are going to keep going up, there are consequences for the economy. So, and you were saying earlier that was an issue. Can each of you talk us through the sort of trade-offs if we are going to keep going down this route of interest rates having to now go up for some time?
Yeah, well, I mean, just I suppose briefly, I think interest rates are going to go up, I suspect, and I think that's probably the appropriate response from central banks. And I think they'll gradually unwind some of the QE that we've seen over the last decade. But I also think that a lot of people think rising interest rates, well, we're going to go back to the sort of interest rates we had before the financial crisis, or what are historically thought of as normal interest rates. Now, of course, that's possible. Very hard to predict these things in advance, but it does strike me as unlikely because I think that there has been, more or less since the 1970s, a long-term secular trend towards just lower interest rates across developed economies. And that's not really driven by central bank policy, in my view, so much as just sort of economic fundamentals, demography, and so on. And so, I don't think that's going to change. So when we talk about interest rates rising, yes, they're rising in central banker terms. I don't think they're going to be rising to the extent that, ordinary people are going to see huge impacts on their life based on the rising rates.
And would you see whatever the rise is, even if it's not to the level that pre-crisis level, of those rises dampening economic growth at all?
Not necessarily, no. I mean, my view is that it's not necessarily the case that low interest rates are better for growth or high interest rates are worse. You really want when you're talking about the Bank of England, a policy rate that's appropriate to the economic conditions. And so there are risks in both directions. There are risks if you have inappropriately low policy rates that inflation can get out of control, and we've seen that in the past. There are dangers as well that if monetary policy is too tight, you can suppress the economy. And there have been incidents in the past. I mean, the Great Depression in the United States was probably a classic example where monetary policy was way too tight and it led to sort of catastrophic impact. So it's always important to remember the risks are on both sides there. But I don't see us heading towards any kind of big problems. I think as long this is probably going way off topic, and you may not want to get into it. I'm not convinced that CPI inflation is the best thing for the Bank of England to be targeting. And I think that the kind of inflation we're having at the moment, driven by supply chains, driven by energy prices, things that are nothing to do with monetary policy, that sort of shows that maybe there are changes we could make to our monetary framework that would guide the path of policy interest rates in the future better than what we've got at the moment. But nevertheless, I think as long as you have a central bank that's sort of independent and broadly guided by clear and well understood rules, we're not going to have a big problem here.
Robert, do you want to add anything?
The only thing I'd add is just, perhaps this is obvious, but of course the bank is playing the long game here as well, in that one of the worst things that could happen long term is if people no longer believe that the bank will control inflation, and so that is critical, and and hard to repair if it goes wrong as well. If the bank isn't seen to be keeping an eye on the medium term on what the rate of inflation is. So I think the bank has very difficult short-term decisions based on how it sees the economy shaping up over the next year or so. But I kind of think big picture, that's the thing really that matters most in 10, 20 years' time, is that inflation expectations don't become de-anchored, because we'll go through a lot of pain trying to undo that error if that happens.
And what's your assessment? Do you think the bank is on the right track against that sort of frame that you've set out?
As far as I can tell, yes. I mean, I'm not a macroeconomist, I should say. I'm luckily not on the Monetary Policy Committee, but yes, I don't at this point see any. And as Tom says, historically, we're not yet talking about particularly large rises in interest rates or absolute levels of interest rates either. So.
But what we have seen is obviously quite a number of those things are outside of the bank's control. But what we have seen is inflation going up very quickly. So it doesn't, for the public, it doesn't inspire confidence to see the inflation level where it is. Obviously, if it starts to go down again, people will feel, that they're less anxious. But that's what's going on. So, do you think that there's more that the bank can do? And you've covered. Apologies, we weren't able to be here at the beginning. Some interesting things going on elsewhere in Parliament today. But what else? What additional policy interventions should be made to reinforce the actions of the bank? Because the bank can't take responsibility, obviously, for everything.
I think we should be so a number of things. So. One, I think the balance of conversation is overly Bank of England focused when it comes to this. Like, the big picture of what's going on in macroeconomics is that fiscal is what matters. It mattered in the middle of the crisis, and it matters more. It's making more difference now. The Chancellor obviously chose a reasonably significant short-term fiscal loosening in the budget last year, which should make us slightly more relaxed about what is now going on. It's not happening on the tax side, but it is happening on the spending side. So there's a fiscal loosening going on. I think that is relative to what was previously planned, I should say. So the pace of withdrawal of fiscal support isn't ridiculous. And so I think and we should focus, and whether or not that is the right judgment is actually much more important than what the central bank does over the coming months, which is the thing we want to talk about. Rightly. I think and that's likely to stay the case for quite a while, just because the numbers moving on the fiscal side are just much bigger. Now, in the medium term, I think you've answered the question yourself, which is that the scale of rises aren't likely to be very large compared to what we're used to historically. So I don't think that's a massive problem. I think probably we should think about it in terms of where the risks lie, a bit less in terms of how we would have worried about in the 90s. And I think I'd probably focus a bit more on if people's expectations change significantly about longer term rates, that will affect asset prices. And so it's not about short-term effects on mortgages, it's about the longer-term effect on house prices, share values and the rest, and I think and bonds for that matter. And I think there we probably do, if I was coming at this from what do I worry about, well, there's a lot of people who won't like seeing the recent 10% rise in their house prices reversing as interest rates reverse. So I think that is more likely to be where you see a problem. I mean, one, I'm perfectly fine if that happens, but I'm saying people aren't going to think it's good when it happens to them. And that is, I'm more confident that something like that might happen than thinking the actual rates themselves are a big deal. Focus on fiscal policy in the short term.
Anyone else want to add anything? Great, thank you. We can let you escape.
Well, we have Gareth.
Last one. The great thing about being last is that most of the things that you plan to ask have been covered. So I won't detain you longer than necessary. But I do want to just pick up on something that you said, Torsten, about unemployment. And we've seen, I think you mentioned that we've seen 18 to 24-year-olds, the rate of unemployment has dropped, I think, to below pre-pandemic levels, which is quite remarkable. But we've simultaneously seen older people leave the labour market. I just wondered what you thought the impact of that would have on wages overall.
So on young people, I should be clear what I'm saying. Unemployment has gone back down to below pre-pandemic levels. That is really good, and that is partly that's basically reflecting the right policy decision to extend furlough and then to get the
particularly for young people.
Amongst young people.
Yes. Yeah.
Now, the thing I would be, but the level of employment among young people hasn't yet recovered. That's partly for a good reason, which is we've seen this 3 percentage point increase in full-time study. I think that's broadly a good thing. The government has, slightly under pressure from the cock-up on the university admissions process, led to more people being in full-time study during this crisis. That may not have been intentional, but I think it's quite a good outcome. But it's also for a bad reason, which is we've seen an increase in inactivity as well amongst some of these younger people, and that's what we should focus on. Big picture, as you say, the increase in activity of around 500,000 is being driven by older workers and then by younger men. And as we've seen an offsetting increase in participation amongst younger women. By younger I mean working age, like prime working age women. And you've also seen an increase in the hours they're working. So the supply increase isn't just about more women working. The ones that are working are more likely to be working full time. So that's the big picture. In terms of what that means for the overall economy, I think about a number of things. So we should be worrying now about what's happening to those older workers, and you should particularly be worried about what's happened over the last 6 months where the drivers of that inactivity are changing, and they're changing towards people reporting they've got long-term health problems. That's the shorter term. It increased during the pandemic because people were like, I'm just not looking for a job, understandably. And now it's people saying, I'm not going to look for a job because I'm sick. And we should definitely worry about that. And we should particularly worry about that because history doesn't give us lots of good reasons for hope. Because we previously had lots of policy failure in terms of getting older workers who are anywhere near retirement back into work once they've dropped out. So I think policy should be really talking about that, which is why it's slightly annoying we're focusing on short-term universal credit sanctions when this is a really hard problem to solve, and that is an issue. In terms of what it does to the labour market overall, it's a bit complicated.
What will older workers leaving do to wages overall?
Right, and so it's complicated. So the reason it's complicated is because workers are both suppliers of labour, but they're also the drivers of demand for labour by spending their income, okay? So insofar as if nothing else changes, everyone carries on spending as much as they're previously spending in the economy, then a group dropping out of the labour market makes the labour market a bit tighter, and that can allow wages to grow in the short term, although the Bank of England, remember, will make sure they don't grow beyond the sustainable limit, so that could be a short-term effect, because it may just mean you get to interest rate rises sooner. Insofar as what is actually going on is older workers are dropping out and being lower income in their 50s because of this point, which is this huge gap between how much money you get as a pre-retirement person relying on benefits versus someone on benefits, then you will see them also dropping their consumption. And so you can't think about a fall in participation as being like good news for young people and their wages, which in the end is determined by productivity in the economy. You've got to think about it as a smaller economy being the main effect that's coming out of it.
So do you think it'll hit the so-called silver pound? Is that what you're saying?
Well, it hit the pre-silver pound or whatever things. But I think this is really serious. People who cannot retire as they were planning in the years before retirement, it can, for some of them, have a really serious effect on their living standards for those years, particularly if they don't have large occupational pensions to draw down on earlier. And I think we should be really worried about some of those people. It's bad for the macroeconomy as well in terms of size of our economy. And the other thing is, I've seen a lot of things, people saying, well, the long-term trend is definitely like more older people working. I'm really worried that we don't have a policy response remotely adequate to getting these older people back. Remember, how have we traditionally dealt with participation problems amongst older workers? And the answer is that we age out of it. It takes 10 years and we've lost them, and a new cohort comes through who does work for longer. It's been a catastrophe. That's the incapacity benefit story from lots of the populations in the 80s and the 90s we had concentrated long-term unemployment amongst older groups in some parts of the country. Our policy interventions did not work, and we let these people retire and then die rather than solving the problem. So it's really serious. And the second thing is, if you look at where the employment growth came from in the last decade, it's basically women, and it's older women in particular, and it's being driven by some of what Rob's talking about on the state pension age rise is driving it. And remember, that is done in the short term. Mm-hmm. So insofar as there's a push into higher participation amongst older workers from the raising in the pension age, that is also done. So I do think we should not be assuming that if we just sit back, we will definitely get back to where we were before on older people's participation.
Okay, I think if the government were here, they would say, or they would at least reference the lifetime skills guarantee and the efforts to do that. But, Chair, I will leave it there because all my areas got covered.
That's great. That brings us to the end. Thank you very much indeed for appearing before us. That's been very helpful. Covered a very wide range of areas. You very generously agreed to write to us on one or two matters, which will be very helpful. And that concludes this session. Order.